Good morning, everyone. I'm Brad Smith alongside Jared Blickery. This is Yahoo Finance Live. Let's get right to the three things that you need to know to start off your morning. First thing you need to know, March jobs reports. That's going to take center stage Friday as investors assess economic data from this week that stoked more recession fears. We saw the U.S. services sector slow and job openings drop to their lowest point in almost 2 years. On top of that, ADP's private payrolls report showed private employers hired far less workers than were expected in March. This all driving deeper worries about the Fed's rate hike path. Focus now turns to non-farm payrolls that's out on Friday for more clues on the state of the labor market. Second thing that you need to know, Skybridge Capital founder Anthony Scaramucci served under former President Trump as White House Communications Director briefly and has since called Trump unhinged since stepping out of the political sphere. Scaramucci has made some big bets on the markets as well. Stocks have fluctuated this week on growing recession fears. Yahoo Finance speaks with Skybridge Capital founder and how his firm is faring, and the state of crypto still in question after the fallout of FTX. As a former business partner of Sam Bankman-Fried, Scaramucci going to share some of his insights as well in the broader crypto landscape. And third thing that you need to know, Costco flashing another sign of weakness in the U.S. economy. The bulk retailer posted its first monthly same-store sales drop in almost 3 years, overall falling by 1.1% last month. In the U.S., same-store sales fell by 1.5%. Now, this comes after the company raised its membership prices and as consumers shop less for discretionary items. Costco stock has fallen about 13% over the past 52 weeks. Well, the threat of a recession has reared its head again after some data this week showed signs of a weaker economy. Treasury yields sank to a 7-month low as stocks also feel the pressure. Investors are now shifting their focus to Friday's jobs report for more clues on where the economy is headed. And Jared, of course, it's a solid reminder here, even as we think back to what Fed Chair Jay Powell had to say about the state of employment after the most recent decision from the Fed. They're still looking at a solid employment situation as of right now, and they're using that as one of their backstops in this dual mandate that they do have as they're continuing to fight hard against inflation right now.
That's right. And we're talking about the headline payrolls number this Friday. That's a big monthly jobs report. That's supposed to come down to about 235,000. But guess what? That is historically elevated. That is still a strong, robust jobs market. Now, what's catching my eye, a couple of things. Yesterday was a real turning point. We had 2 data points that came out. And then in addition to the jobless claims this morning, I want to point to the Wi-Fi Interactive, where I'm going to show you what's happening with S&P 500 futures right now. Now, we can see here at the 8:30 a.m. mark, kind of hard to see actually, we did get a little bit of movement there, but the net movement was down. And that is, we had a worse than expected jobs report and stock futures moved down. That's very similar to what happened yesterday at 8:30 a.m. as well as 10 a.m. Now yesterday, or 8:15 a.m. yesterday on that ADP number, that's private payrolls. We're talking about that as well. We got a downdraft there. And then at 10 a.m. for the ISM services that missed. So the bottom line is 3 reports in 2 days. Bad news equals bad news. Maybe people aren't concerned about the Fed, or maybe aren't thinking the Fed's going to pivot and all is going to be well. Maybe the economy and the stock market have to take a bigger hit given this rash of economic data. So I see that as a change here.
Yeah, and that's starting to show up in some of the commentary that we've gotten from CEOs, even JP Morgan's CEO, Jamie Dimon, of course, even as he had put out his annual shareholder letter earlier this week. One of the things that he'd said, yeah, here and now, as Luther Vandross would say, still good economy. But in front of us, storm clouds ahead. And one of the things that he pointed to is what the Fed may do and is going to continue to do, considering some of the economic data that you had laid out. And what they're looking for is a trend, is what Fed Chair Jay Powell and the rest of the FOMC committee is going to be tracking for. But in this near-term period of time, focusing on that abnormal quantitative tightening and spending particularly here, because that large quantitative tightening and other unknowns, reducing liquidity, triggering higher long-term interest rates, that is one of the near-term headwinds that CEOs are starting to wrap their minds around even more so right now, and how it may impact their business.
Exactly right. And we had this banking crisis unfold over the last month. It's a liquidity crisis at its core, not necessarily a credit-based one. And so QT, Jamie Dimon mentioned that 8 times in his letter. I think that's going to be a mantra for the coming months here. Got to move on because it has been a busy week for Trump, who was arraigned Tuesday on 34 felony counts in New York City. In the latest setback for the former president, Trump administration senior officials have now been ordered to cooperate with the Justice Department January 6th probe. And joining us now is Skybridge Capital founder Anthony Scaramucci, who served under Trump as White House Communications Director. And Anthony, great to see you this morning. Thank you for joining us. Got to talk about the news of the week, and that is Trump. We've seen the indictment now, and I guess expectations are running in a couple different directions, especially with respect to the implications for the Republican Party. Having served with him in the administration, in the Trump administration, I'm just wondering how you see it, sir.
Well, I mean, listen, I think I have a little bit of a contrarian take. I don't like the case. I think the case is being brought against a former president. It needs to have more meat than that. There's technical things in the case that lawyers really understand between misdemeanors and felonies. There was a little bit of a conversion there to extend the statute of limitations. I don't necessarily think that was fair either. So that notwithstanding, I certainly don't want Mr. Trump to be president again. He doesn't have the executive management skills to handle that job, and there's just too much negative attention associated with him. And of course, he would do things I think that would be very harmful to the United States. But the case is not a great case. I think the Republicans would do way better if they found a better messenger for their movement, a younger person, probably with better, fresher ideas. The country has changed. We have this beautiful, colorful mosaic of demography in the United States. It's a very different country than it was in 2016. And I think we need a Republican Party that has an entrepreneurial candidate that sort of cuts the ideas of that party to shape and reflect what's going on in our population. So hopefully that will happen. That's clearly not Mr. Trump. But I will say one last thing. He's got an avalanche of things coming. He's got the Georgia situation coming and a likely indictment there, the J6 situation, and of course, the document situation, which there'll be a lot of hypocrisy about, because if they go after him for the document situation, well, they'll have to go after other people like President Biden. So we're in a little bit of a mess, as we usually are, but it's an amazing country, and I really do have a lot of reasons to be optimistic for things in the future, but it's a rough period of time right now.
Hopefully a more informed country over the time that these cases continue to move forward as well. Considering the other cases that you mentioned here and kind of looking past what's taking place, as you kind of called the New York case, a very weak one, which has been the commentary and been the broader thinking around what even took place this week. But still, you've got the Capitol riots case, you've got the 2020 elections case, of course, in Georgia as well. So with all of that considered, and how the GOP will also need to shape their own future considerations for who the party nominee is, should then the markets also be taking off the table any possibility of a Trump presidency or a Trump nomination from the GOP in the future?
Again, I have a contrarian take. I think he drops out of this race before the Iowa caucuses. I think you've got the additional indictments coming, which are going to be very distracting and time consuming. And, people don't like me saying this about Mr. Trump, but he is a family person. He may have a dysfunctional family, maybe a little bit of a weird guy, but he ran a family business with his family, the Trump Organization. He ran a reality show just like that as well. He ran the White House with his family. And his family is conspicuously absent here. And remember, these are cases, at least the ones in New York, about personal indiscretions, which I think is also causing him some personal strain and anxiety. So the combination of those things, I think, take him out of the race. But as you and I both know, anything can happen in America. Could he get the nomination of the Republican Party if he stays in the race? Well, then I predicted he would get that, because they'll have 7 or 8 Republican other candidates in the race. They'll each mete out 5-7% of the vote. He'll get his requisite 25% of the vote. He'll get the nomination. But I honestly don't think there's a path to the presidency for Mr. Trump, given the changes in the demography and given his approach to campaigning, the style, the rhetoric, the hate speeches, all that stuff. But anything can happen in America. We both know that. I don't think the market is really thinking about that right now. The market seems more focused on the macro dynamics around the Federal Reserve, the cause for fighting inflation right now, and what's ultimately going to happen as the economy heals from the COVID-19 situation.
Yes, and let's talk about the Federal Reserve and the markets. As we have you here, we were just talking about some economic data this week, especially with respect to payrolls, PMIs, manufacturing and services data coming in a little bit weak. And then you have the Fed that still has to fight inflation, achieve its dual mandate. Just wondering where you see the markets right now.
Well, listen, the bond market's telling you that the Fed doesn't have a lot of room left to fight inflation, that they're going to probably have to let it go and maybe move the target. Other people, people I respect in the hedge fund industry, believe the Fed and think the Fed will stick to this 5% interest rate handle, possibly a little bit more to fight inflation. I actually think there's great irony here because the inflation is going to come down one way or the other. We have all of this induction of new technology coming into the marketplace. The reconnection of the supply chain post-COVID-19 is going to push the prices down. And so the Fed's going to win that, even if they don't move more excessively as it relates to interest rate hikes. A big problem for the United States we have to address is 38% of the debt is rolling over the next 2 years. You'll likely pick up a 400 basis point handle in interest rate expenses. That could take U.S. interest rate expenses up to what we spend on our military defense. So I would be a little bit worried about that and cautious about that. Unfortunately, you've got a push-pull system going on in Washington right now. The Fed is trying to fight the inflation, but the Congress and the president just passed a $1.7 trillion spending bill, which increases demand and pushes prices up. And so there's a little bit of a lack of coordination between the monetary and fiscal policy. My recommendation would be we need long-term thinking, a bipartisan commitment to bringing down the deficit. We did that in the early 90s with the pay-as-you-go legislation that was adhered to by George W. Bush's dad, George Herbert Walker Bush, and Bill Clinton. Remember, that led to a surplus at the end of the year 2000. But unfortunately, we've lacked that discipline in the last 20 years. We can get it back, but it would really require a bipartisan coordinated effort. And the only thing these guys seem to be agreeing on is the fight with China. That seems to be the only thing that these two parties like joining forces on. But there's other things that we need them to join forces on, frankly.
Anthony, my apologies. Just want to go backwards for 1 second here. Given the fact that we had learned a lot more over the recent weeks about Trump's business dealings and some of the business practices kind of being elucidated through what this proceeding has looked like even thus far early on, you've got a lot of investors that are out there looking at SPAC stocks like DWAC, Digital World Acquisition Corp., which of course tied to Truth Social, the Trump-led social media platform here, where he's been kind of the harbinger of some of his own outbursts against the legal proceedings and, of course, so many other things under the sun. But at the end of the day, is there anything that investors in a ticker symbol like DWAC should be heeding from what's coming to light about business dealings from the Trump organization over the course of this week?
It's a really good question. I'm not close enough to the situation. Obviously, the market is telling you that there's something wrong there. It's a really good question. I think you're also bringing up a point that's worth adding. If Alvin Bragg, the district attorney here in Manhattan, has more information that hasn't been elucidated yet in that indictment, I think it would change my view of the weight of the case. And so there could be things going on that you and I don't know about yet. And perhaps there are market participants that do know about them and they're acting in the market on that information. But I don't have that information. Just on the case prima facie, the way it looks right now, if you're going to bring a case like that against a former president, you got to be super careful, because what you don't want to have happen in a country like this is still amazing country, rule of law country, great entrepreneurial culture in this country, great tradition of adhering to the fairness of the law. You don't want our political people building jail cells for their political adversaries. We don't want to go down that path. Once that starts, it's a very slippery slope. And so I think the threshold and the standard for these sorts of things has to be very high.
Understood. Just had to get that question into you. I do want to come back to the markets, though, very briefly here. Even as you kind of manage your own portfolio through some of the volatility that we've seen over the course of let's round it out to the past kind of 6 to 9 months here. More largely, where have you been kind of doing some portfolio pivots, some readjustments? And what have you been hearing from investors, even in your funds right now?
Well, listen, I had a tough year. I think it's fairly well documented. I mean, your competitive media outlet writes an obituary about me every 2 months, apparently.
But they did one a couple hours ago. Yeah.
Yeah, of course. Yeah. And so she'll probably write another one. She wrote one in January. She's writing one here in April. She'll probably write another one. But I'm not going anywhere. We've got a great business. I'm 35 years in the industry. Skybridge is 18 years old. We had a very difficult year last year. We were down about 37.5% after the audit was completed. We're up about 10% now this year as a result of good performance in the first quarter. I like the way we're positioned. If you look at the filings, you'll see that I'm adding personal money to the fund every single month. And so I'm very encouraged by what we're seeing. When you step back and look at our portfolio, it's a fairly transparent portfolio because it's a registered fund. We have great names in there, some of the world-class hedge fund managers, and we have some digital asset exposure, which I think we're going to be proven right upon. It's just an early adopting story, and with early adopting stories, there comes some volatility. But I think the long-term investors in Skybridge will be rewarded, and I think we're very well positioned given what's going on right now. You have a regional banking crisis in the United States, and there is a crisis of confidence related to deposits and how the Fed is going to handle these things. There will be a move, maybe slowly in the beginning, but there will be a move for diversification into more digital assets, specifically things like Bitcoin and Ethereum. And I'm very proud to hold those things, and I'm very proud to take the heat and stand before people. I just found it very telling. The biases in that article. I'm in the business 35 years. They couldn't find one person to say one positive thing about us, and that's fine. I mean, I've heard a lot worse, though, guys. Remember, I've been in the political system, and until you've been parodying on Saturday Night Live, you don't know what a real roasting is. And so I know how to take the punches. We'll be here, and I appreciate you guys bringing me on this morning.
Well, Anthony, let me ask you, what's the path forward for Skybridge with respect to crypto? You've had to introduce some redemption limitations. Are those pending here? What happens with crypto prices as they rise, and what happens if they fall? For instance, if there's a fallout with respect to Binance?
Yeah, it's a very good question. But I mean, again, provide context around that article and just the facts. I think it's very important not to have this thing be overly biased. We have in our prospectus the right to move our tender. It's a closed-end interval fund that tenders every 6 months, and then pursuant to the board and our recommendations and so forth, we can have a 5% tender or a 25% tender. We reduce that tender primarily because of the zigging and zagging that sometimes takes place in the wirehouses. There was a buy on that fund in February. They abruptly move it to a sell 4 months later. And we have a lot of privates in that fund. And so 33% of the fund is private. As a fiduciary of the fund, to maintain the integrity of the fund and the consistency of the percentages around the portfolio, we have to do those things from time to time. In the 21 years that fund has been open, the average tender is about 20%. There's been 8 or 9 periods of time where we reduce it to 5. And by the way, every single time we reduce it to 5, it was beneficial to the investors. You guys remember the 2008 situation. Investors that held on more than made their money back and got very high returns. Now, you're asking about the volatility in the crypto markets. Bitcoin's down from 100 vol. It's probably a 50 vol asset right now. There is Bitcoin in that portfolio through some of our hedge fund exposure. I would guess right now that we're through the bear market. And again, that is a guess. We don't know. But any time that you've held Bitcoin in a 4-year rolling interval, so you pick the day, hold it for 4 years, you've outperformed every other asset class. We made that position, we made that investment in November, December of 2020. We are up on that position. Now we're down from the high, and that's what gets all the press because the press likes car crashes. But we're up on the position from November of 2020. And let's see where the position is as we enter into the halving cycle in February of 2000 or April of 2024. I like the odds there. And you mentioned Binance, so I think it's worth mentioning Binance. It is a super important centralized exchange in our industry. If something happens to Binance, I think there'll be a short-term hit. We were talking about FTX at the opening of the show. You guys know I had a relationship there with Sam Bankman-Fried. When FTX went down, it hurt the crypto market, but it was a temporary hurt to the market. I think Bitcoin got to 16,000. It's now well through where it was on the announcement of that debacle. You guys may remember something called Mt. Gox that failed in 2014. 60% of the Bitcoin trading was on that exchange. People say, well, that's the end of cryptocurrencies and Bitcoin. Of course, that didn't happen either. And I wish CZ well. I know him personally. I like CZ. I hope he sorts through whatever these issues are. I certainly don't want to see anything happen to Binance. But I think people need to understand that the ecosystem known as the cryptocurrency markets, Bitcoin, Ethereum, et cetera, are very resilient. And there's a lot of pent-up demand coming into the space. You can just see it in the on-chain analysis that we do at the firm.
Yeah, in aggregate, it hasn't been a good 6 months for some of your most high-profile homies there, Anthony. However, at the end of the day, I mean, one of the things that you are focused on, we know for so many of the investors that you answer to as well, is just how you find some of those pivots, how you continue to find value even in these markets, distressed as they may be in the most risk-sensitive parts of that, and especially in crypto here. And I've even been tracking CRPT. I just wonder, even within the resilience that you're talking about, more broadly internationally, what the playbook is going to be for crypto still remains to be seen in some other large economies of scale right now. And so that considered, is there any hesitation? Is there any pause? Is there any pulling chips off the table that you feel like needs to be done right now in advance of another shoe dropping internationally on crypto regulation?
Listen, again, these are great questions. It really depends on your time frame. I don't think this is really an asset class that people should be trading. I think one of the problems with the asset class, unfortunately, it's a brand new asset class in the sense that it's a new technology. And what happens is you get these boom bust cycles and you get the introduction of a lot of charlatans, which has obviously caused this regulatory snapback. And so, yes, there could be more regulation. But when you look at an asset like Bitcoin, it's very decentralized, and you're mentioning the international community. While some of the regulators may take a tough stance on Bitcoin, I can tell you the general population, particularly off the shore of the United States, where they've lost confidence in the governmental-based currencies, and you've got billions of people in places like Africa, South America, elsewhere that are unbanked. I think you're going to find that there'll be more and more people adopting Bitcoin in other cryptocurrencies. So the demand is there. To understand the database that Bitcoin represents, it's immutable. And if you really study the history of money, what has happened to us with money, it is basically the technology that we're using to avoid bartering with each other. But the money is always getting corrupted by the government. You now have the opportunity to use technology to prevent that. And I think there's a big market share for that globally. So we're in the cross currents of all that. It makes it very interesting. The asset class is up a lot this year. I think Bitcoin's probably up 70% on the year. And I don't think it's time to take chips off the table. If anything, I think that this is the beginning of a new era for Bitcoin and other cryptocurrencies. And so we'll remain patient and we'll remain disciplined to the approach that we've had for the last 20 years, which is to make a macro bet, sit patiently, and take the heat from the pundits and the critics.
All right, we got to go, Anthony. We really do appreciate the time this morning, though, talking through some of these matters here. I mean, we have to go, but Bitcoin, 1 million, yes, no? You think it's going to hit that?
Oh, listen, I've been wrong about timing, but, I mean, if you ask Tim Draper or Kathy Wood, if this trades to where gold is or slightly better than gold, it's a $500 to $1 million coin. And that could happen by the end of 2030, of course. And so we'll see. Right. But here's what I want. Here's what I hope, though, guys. If I'm right, okay, because I'm taking a lot of public dunkings right now in the public scare. I'm even getting my personality attacked and all that other stuff, which is fine. I'm a big boy. But if I'm right, invite me back. Okay, if I'm wrong, you can also invite me back and throw eggs and tomatoes at me. But if I'm right, invite me back. It'll be fun to share that success with you and your viewers.
Eggs cost too much to be throwing them at anybody right now. Skybridge founder and managing partner.
Tomatoes, the tomatoes. I'm getting hit with tomatoes.
Thanks so much for the time. We appreciate it, Anthony.
You're welcome.
All right, guys, switching gears here. Shares of Costco, they are on the move here pre-market after a tepid report on March sales. They're down right now. Shares are by about 3% before the start of trade. And then you got to think about this gain in comparable sales. This has been the smallest increase for the wholesaler since April of 2020. It comes as the U.S. service sector growth slowed in March. ISM index fell to a 3-month low, according to data out yesterday. We've got more on the outlook for Costco. That's coming up later on in our show. Plus, one more thing here, as Tim Cooker, Tim Apple, however you would call him, would say. Masters tournament kicks off today, Augusta National, where several live golfers are also going to be rejoining the field. Plus, 5-time champion Tiger Woods tees off just after 10 a.m. today in his 25th tournament appearance. But betting odds favor the top 3 PGA players, Scottie Scheffler, Rory McIlroy, and Jon Rahm, to win it all. Later on today, we're going to be talking the best bets for the weekend ahead if you're hoping to make some bets or wager some money there. But likely lose some money as well. You don't want to miss that. Productivity will no doubt slump at most offices around 10:18 a.m. Eastern Time. Switching gears here, first quarter earnings season entering full swing, less than 2 weeks. Let's hear what one market expert had to say about where Wall Street analysts stand heading into the season here.
I think analysts are still in la-la land, Jared. They're expecting earnings to grow low single digits this year. There's a lot of dispersions across sectors, but I think that's wrong. I expect earnings to drop 15 to 20% from where we stand today. It seems like a big number, but it's just consistent with an average recession.
You can read more about the upcoming earnings season in today's morning brief, written by Jared Blickery, the man to my right. It's up now right on the Yahoo Finance homepage. All right, Jared, walk us through this. I mean, we were both listening to those comments
24
yesterday.
hours ago, this was all breaking down. So we had Alfonso Peccatiello as well as Matt Maley over on at our studios yesterday. And one of the things that we're talking about as a predecessor to recession is earnings, re-rating. Basically, you have the S&P 500. Earnings are expected to be $218, $220 per share if you were to average the entire basket and weight it according to market cap, all that good stuff. And you can see plotted over time, this goes back, 5 years or so, might be off. But that blue line is earnings estimates for the S&P 500. That's on the left scale. On the right scale, you have the S&P 500 itself. What happens usually is they drift down those earnings estimates as we head into earnings season. That's what's happened here. But we really haven't had a major revision cycle lower in some time. And that's the thinking, is that it's probably going to come with respect to some of the guidance that's announced this season. So if that happens, that's just one more checkbox on the, I guess, the checklist for recession. And kind of knocking at our doorstep right now. Now, Alfonso is saying that he's expecting that recession to come as early as June. That's about midsummer, and that comes a lot earlier than other people who are saying even a hard landing probably not going to come before the end of the year. So just to say there are differing opinions about this, and I guess there is still a possibility of no landing, a recession years in the future, but that seems way off base, or at least not off base, but I would say the probability is that quite a bit lower since we've had that banking panic in the month of March. All right, let's continue this conversation ahead of earnings season next with our guest, Quincy Crosby, LPL Financial Chief Equity Strategist. Quincy, great to have you here. We've been talking about the data that we've been getting recently, and one of the things I noticed over the last couple of days, bad news kind of means bad news in the market. In other words, these reports are being released, they're not living up to expectations, and we're seeing stocks or stock futures drop on the announcement. That tells me maybe traders aren't thinking that the Fed is going to pivot that hard or that fast, or it's not going to be soon enough. Just wondering what your thoughts are.
Well, there's another worry in the market, and that is that perhaps we're moving into a stagflationary environment. And this is something that the Fed and no central bank wants, which means that they will keep at it until they managed to get inflation down as close to, the 2%. They're not going to get to 2% right away unless there is a deep recession, and that'll do the work for it. But they do not want any hint of stagflation. You notice that he always talks about no pause, he's talking about the 1970s where we had stagflation. And when Paul Volcker took over, he had to go at it unbelievably, bringing the rate hikes up dramatically. He doesn't want to go in that direction. So the point is that the Fed will probably keep going as long as they can unless something else breaks. And when I mean break, I don't mean the crisis, quote unquote, that we had in the banking sector, but something much bigger that has a tremendous contagion in other classes. So I think they're going to have to keep going.
Even as we kind of strike the opening bell here in the U.S., a lot of investors are still trying to think about, all right, we're not trying to fight the Fed, but how can we best anticipate them and make decisive portfolio decisions with that intention? What would you recommend?
Well, you're in a position right now where you're starting to see, the value defensive names starting to pop up again, following a period in which, every rally we had was oriented, the orientation was to cyclical, to recovery, semiconductors, consumer discretionary, all the things that you want to see in a rally. Now what you're seeing is the market suddenly resurrecting utilities, resurrecting healthcare, consumer staples. We thought we had buried that and that we were just marching towards a recovery into a more bullish environment. The market, and we always have to say, we trade and invest in the market we have, not the one we want. We need to see if this movement into those defensive names is viable. Is it just a couple of trading sessions? That's not what we want. And so sometimes it just pays to, pull back, watch what's happening, and make a decision. We're going to be helped by the labor market report on Friday. That's going to help us in assessing whether or not the labor market is dramatically pulling back, because a real recession in our country, it starts with the labor market. And when that starts hurting, consumer spending follows, personal income follows, and that usually brings us to a full-fledged recession. We're not there yet. And so we want to be constructively optimistic, but not naive. Right now, we would be looking at, again, short duration treasuries for the portfolio. That is still attractive. It's still secure, and we would place money there. We also like the preferred stocks. They're offering, value. They're offering a return. We wouldn't be shooting out the lights with them because that requires much more risk taking. But even with some of the large banks, the large money center banks, the prefers are actually quite attractive. So again, there comes a point in a market where, patience helps because we are transitioning to a slowdown. The question is it leading us to a recession? By the way, the yield curve is showing us that the 3-month and 10-year has deepened with each and every negative. And as you said, the market treating it as bad news is bad news. That's indicating a recession is coming sooner than we are projecting.
So if we take stock of the first quarter performance where we saw the Nasdaq up something like 17% while the Dow was languishing, did the market simply get that wrong? Was it an artifact of an unusual environment? And should we not be extrapolating that kind of outperformance by tech and growth going forward, given what we know now?
Well, you can't negate the price action in the first quarter. It was tremendous. It's just that suddenly you've got an added brick, shall I say, to the wall of worry, and that is you're concerned about the loan environment, banking environment in terms of credit availability. that hurts. If we, in fact, see loan origination slowing and slowing dramatically, and individuals and small business owners can't get access to attractive loans, that is going to hurt the economy much more. We didn't have that in most of the first quarter. And it was also interesting how well the market was able to navigate around the quote unquote crisis in the banking system. But you still also have worries, and you don't want to overplay it. There are always worries, but the very same conditions that fed Silicon Valley Bank, Signature Bank, and so on, they're still there, and they fed, with easy money, low rates, practically zero rates, commercial real estate, private equity, venture capital. So it is most likely over the next number of months, we're going to see pockets of vulnerability there too. You want it to play out, because the more it plays out, the more it's not a shock to the market. But that's why, as you pointed out, the earnings season and guidance is going to be extremely important to help define where we are heading and what companies are saying, particularly about their operating margins. That's going to be key.
We're going to get that commentary in scores over the next several weeks here.
Yeah.
LPL Financial Chief Equity Strategist Quincy Crosby. Quincy, thanks for the time this morning.
Thank you.
Certainly.
Thank you.
Well, the markets are officially open here in the U.S. as we're taking a look at the major averages. We've got them there for you on your screen. Of course, always locked and loaded. And the Dow, the S&P 500, and the Nasdaq, yeah, they're seeing some red on the screen right now. The Dow Jones Industrial Average down by about 0.1%. S&P 500 down 0.4%. Nasdaq Composite also in the red by about 0.8% here. Jared, this ahead of Jobs Day. Of course, the market's going to be closed tomorrow in observance of Good Friday ahead of Easter weekend. However, for the last trading session of this week, what are we seeing early in the tape?
Yeah, first of all, really important to point out the schedule, the holiday schedule. Tomorrow, stocks are going to be closed, but stock futures are going to be open for a very brief window. I think they close at 10:15 a.m. or maybe 9:15 a.m. Anyway, very brief window that they'll be open, yes, tomorrow. But today we're dealing with a negative tape here. But let me just show you what's happened this week, the first 4 days of the quarter. So here the Dow is up about 44 basis points, about 0.5%. S&P 500 down nearly 1%, and the Nasdaq has been really the lackluster underperformer here, down 2.5% when it was a huge outperformer, as we were just talking about with Quincy in the first quarter. So here's a look at what's happening inside the market. S&P 500 sectors, all 11 of them, a mixed bag. Utilities, that is a leader today. That's up 0.75%. XLU followed by healthcare, real estate, and staples. All four of those are defensive. So when you have green in the defensive, that is not a risk-on statement. To the downside, tech, XLK taking it on the chin. That's down 1%, followed by consumer discretionary, materials, and energy. Energy has really been in the forefront this week because of that surprise OPEC Plus decision to cut production. I'm going to be talking about that at the top of the 11 a.m. hour. Here's the Nasdaq 100. As you can see, more red than green. Applied Materials down 4%. So is Airbnb and Workday. Aside from that, not seeing too many huge movers or outstanding issues moving to the upside, Brad.
All right, a lot to keep tabs on. Early in today's trading session, of course, we've got a lot of time on the clock. Jared, let's dive into some of today's market movers as well, starting with Costco. Shares lower by about 2.4% as the retailer saw comparable sales fall for the first time in almost 3 years, as adjusted same-store sales growth continued to slow in March. You're taking a look at that share price reaction here. You've actually got a note out from Stifel this morning as well, saying and acknowledging that non-foods weakness is most notable and likely reflects generally muted discretionary spending intentions given inflation in recent stock market and ongoing macroeconomic volatility here. It's been a big week just tracking what some of the retail companies are saying, either through their figures that they're reporting. And for Costco, of course, we get kind of more frequent or cadenced sales numbers from them than we do on a quarterly basis like some of the other retailers out there. However, we did have some commentary from Walmart to even compare this to this week with their own investor event. So all of those things considered, a lot of focus on the retail sector and where grocery is holding up versus some of the weakness in discretionary spending as seen through Walmart and Costco here.
Right. I think what really stands out to me, we're talking about top line numbers here. Yeah. Revenue, there's no fudging this. Either you made the money or you didn't, or you're lying about it. So in this case, these companies, Costco, they're going from sales of 15% last year. That was the sales growth last year. That's going to be cut in half to about 7 or 8% according to street estimates. And then the comp sales, that's going to sink beneath 5% for the first time since, I believe, before 2019. So we're really reverting to a slower growth environment. Now, it doesn't mean that Costco can't execute better or execute better than its peers and beef up their margins, cut costs where necessary. But this is really indicative of the environment we're going into. If top line numbers are suffering, those bottom line numbers are going to suffer even more if you're not executing here.
They got a lot to deliver on, especially at a time where they're charging a little bit more for those memberships as well.
Yes. Shares of AMC swinging to the upside as preferred equity units take a tumble after U.S. court denies the theater chain's request to lift a status quo order, thus leaving AMC unable to start a series of transactions to convert its preferred equity unit to common stock. And we've been following this saga for quite some time. And a lot of thoughts coming into this decision was that it was just going to be rubber stamped. But that is not the case here. The shareholder motion that would have allowed this event, that took place. They got the votes they needed. So the shareholders are okay with this. But the judge is saying that no, we don't have, at least according to the way he sees it or saw it, didn't have the evidence there to fall in line with what he was expecting.
This has been a fascinating company to track, of course, not just for the meme stock craze and frenzy that had taken place and really pushed AMC to the throes of the dinner table conversation alongside GameStop, GME, a ticker symbol that grandmothers were probably out there printing on hoodies after a certain amount of time, given the fanfare that was taking place around all of these names. But at the end of the day, there's kind of two different frames to think about how management has gone through this. And on one side, you want to say, yeah, they were getting creative. They were trying to get cozier with this particular cohort of investors, this retail trader that might have more of a propensity to say, you know what? Not only do we believe in the business enough to try and invest in it and try and, just squeeze the shorts out to a certain extent as well, but now for that investor specifically, trying to cozy up and say, all right, we're going to create more opportunities for you to be an exclusive shareholder in, the 8 shares or, have some type of tandem offering that we're willing to layer on just to get you into that movie theater experience. And then on the other side, you have to hit on management for also not realizing some of the legal ramifications that take place when you do have such a mass dilution of shares that is being put forth, like the one that took place with the Ape Mutants as well. Yeah,
sometimes even if investors approve something or allow it, you can't just wish it away with disclosures, and that's the way the industry is run to protect investors putatively. Got to talk jeans here. Levi Strauss beating estimates in its latest quarter. However, they're seeing a dip in operating income, and that's due to lower gross margins, higher expenses, and its net income, that's profits, also takes a fall. Looks like shares trading down. I was looking, this is the worst day that the stock is having in 6 months, and there you can see some of the figures on your screen. I think this is just another execution story. This is interesting because we're just starting the earnings season right now. And as it turns out, Levi, their earnings season ended on February 26th, whereas most of their peers are going to be reporting on results that ended March 31st. So they get in the mix a little bit earlier. There's going to be some outsized attention on this, but I don't see anything that's moving the needle for me in terms of apparel that I didn't already see before.
Yeah, in terms of the kind of international segments that you look at here, or at least kind of segments by globe, the Americas was down, Europe was down as well. Both of those missing estimates ultimately, and that's what I should say and frame it as, rather missing some of the estimates both in the Americas and Europe. And then you think about how the company is positioning itself going forward right now, and saying that, I think in some previous interviews, saying that skinny jeans are still going to hold on strong. If anybody has been tracking what the Gen Zers out there are doing, there's a lot of baggy jeans out there that are making a comeback. I'll have to probably dig mine back out of the closet from back in my kind of youth days. But anyway, at the end of the day, if you have a major shift in fashion trends that continues to hold strong, then that could potentially be an inventory concern for a company like Levi's, who is already moving so much of kind of the trend-worthy SKUs into production, or getting those into stores as well where they operate. This is also a company that, of course, is going through executive change over there. Investors could be trying to price in what that turnaround will need to look like, given that they've got the new CEO who comes over from Kohl's, and we know how embattled that name had been as well in recent years.
Yep, inventory's up for most companies, and I guess they've been taking care of that. But in terms of Levi's, I believe those were up ending the quarter as well. All right, coming up, the outlook for global growth. Yahoo Finance's Jennifer Schomburger has the latest projections from the IMF, and they're somewhat dour. And the IMF improves its global growth outlook. We're going to talk about that in just a couple minutes. The IMF previewed its global growth outlook this morning ahead of its World Bank meetings next week, and it's not very optimistic. Yahoo Finance's Jennifer Schomburger has the details. I'm looking at the worst prediction since the 1990s here.
Hey there, good morning, Jared. That's right. IMF Managing Director Kristalina Georgieva giving a speech just now, her so-called curtain raiser speech ahead of the IMF World Bank spring meetings next week, where she said that the IMF expects global growth to expand at less than 3% this year. Now, they're going to release their official World Economic Outlook next week, where we will get more details on this outlook. But that's about in line with their estimate back in January of 2.9%, which was 0.2% higher than what was forecast back in October. But looking ahead, things look more dour. The IMF projects global growth to remain around 3% over the next 5 years. That is the lowest medium-term growth forecast since 1990 and well below the average of 3.8% from the past 2 decades. In 2023, emerging economies are the bright spot, with India and China expected to account for half of global growth. The IMF sees economies in the U.S. and Europe slowing, however, where higher interest rates will weigh on demand. About 90% of advanced economies are projected to see a decline in their growth rate this year, says Georgieva. With rising geopolitical tensions and still high inflation, a robust recovery remains elusive, says Georgieva. The managing director also weighed in on navigating inflation in the midst of these global banking issues following the failure of Silicon Valley Bank and Credit Suisse. Georgieva says as long as financial pressures are contained, central banks should, quote, stay the course, implying continued rate hikes to bring down inflation. But at the same time, she said, quote, that central banks should address financial stability risks when they emerge through appropriate provision of liquidity. She said the key is to carefully monitor risks in banks and non-bank financial institutions, as well as weaknesses in sectors such as commercial real estate. Now, she also added concerns about vulnerabilities may be hidden in banks and non-banks, and that, quote, now is not the time for complacency. Jared?
All right, I'll take it from here. Thanks so much, Yahoo Finance's own Jen Schomburger. Jennifer, we appreciate it. All right, guys, coming up, taking off into earnings season, how airlines are positioned ahead of quarterly results. That's coming up on the other side. Airline infrastructure gets a stress test. Rising spring break travel providing a critical check ahead of the summer season. This as the industry is set to realize the gains from route cutbacks and airport improvements. But is it sure to sizzle or set to fizzle? Joining us now, we've got Mike Boyd, Boyd Group International President. Mike, you've joined us in the past and talked about what the infrastructure needs to update here for airline operators to really service customers the best here. And that also stems even up to some of the investments that need to be made at the federal and regulatory side as well. And so have any of those investments been made thus far? in advance of what is anticipated to be another busy summer travel season?
Well, as far as the investments in our physical plant, anybody like me who grew up near LaGuardia Airport goes there today and thinks they've arrived on another planet. I mean, we've now put in a lot of new airport facilities. We have the best airport system in the world. Real issue here is our air traffic control system has fallen behind. And unfortunately, airlines and the consumer is going to have to adjust for that with less capacity out there. And that's all across the country.
And I got a notice last week that American Airlines cutting capacity specifically at LaGuardia. And as you're writing, this affects not only New Yorkers, but people all across the country and potentially the world, because this is a gateway to other locations. And I'm just wondering, are other hubs similarly situated?
Well, sure. American Airlines cutting frequency to Chicago, which is another one of its hubs. That means there'll be fewer connecting seats to Spokane, fewer connecting seats to Omaha. So it affects everybody. And airlines have a very limited ability at this point in time to move airplanes around. In other words, replace a 100-seater with a 200-seater as a general idea. So it's going to be fewer seats, but it is going to affect the entire nation because we just haven't invested as we should have over the years in an air traffic control system. It's been bureaucratic. Until we get that fixed, we're still going to be in a constricted air transportation mode.
Are we witnessing a reset to the real capacity benchmark that is going to be kind of at available, or at least kind of talked about among the airlines as well? Because all of them have said, yeah, 2023, we're in pretty good position to get back to 2019 or pre-pandemic norms in comparison to the capacity figure. But if you're kind of cutting permanently or suspending some of those routes, what does that do in terms of the normalization of what they would see as 100% going forward from here?
It's called higher fares. I mean, bottom line of the whole thing. Now, I've talked to a couple of airline CEOs over the past couple of weeks, and there's some optimism about what's going to happen in the future, but they know it's very uncertain. But things are pointing in the right direction. I honestly think that leisure air travel somehow has moved up the food chain of needs from where it was 10 years ago, 5 years ago, where that trip to Florida, that trip to Phoenix is far more of an important event than it was before. So I think we have a different travel model today. And I think there's carriers like certainly Frontier, Avelo, Breeze that are bringing new capacity into a lot of markets. So it's a strong market. But again, when you have to cut back on capacity, that means what capacity is left is going to cost you more.
And you were talking about the FAA really not being up to snuff here in terms of what it could be or what capacity demands of it anyway. And we saw this fallout with Southwest Airlines. They had not invested in the CapEx to update their reservation, or at least their pilot location and flight attendant location systems. We're not able to serve tens of thousands of customers. Any other potholes like that are in the industry that might be popping up over the next year?
Well, I think the good news, if you want to call it that, this airline Grinch that stole Christmas at Southwest, unfortunately, they're fixing that, but that was due to Southwest internally. On the other hand, we do have an air traffic control system that we've been talking about since 1994, Congress elsewhere, that needs professional attention, and it has not been given that. The problem is the FAA, I don't think they can invest in a stapler without getting some kind of an RFP to stapler companies. That has to be fixed, and until it is, I don't care who's running the place, we're just not going to have it. That has to get fixed. But as far as our airports go, I'm pretty proud of the United States of America.
All right, if all they need is a stapler, they can borrow some of my coins, and I'll fund the stapler. Mike Boyd, Boyd Group International President. Mike, appreciate the time this morning.
My pleasure, sir.
Thanks. Time now for our chart of the day. We're taking a look at the startup economy. New data from Crunchbase finds that venture capital funding in the first quarter reached nearly $76 billion. Now that marks a 53% decline year over year from the $162 billion in the first quarter of 2022, a sign of major pullbacks in investments into private companies by growth and venture investors, despite the massive $10 billion investment by Microsoft into OpenAI and a $6.5 billion round for payment giant Stripe. Also notable is that these drawdowns happened across all funding stages. Despite these pullbacks, VC investors still hold record levels of dry powder, estimated by Lightspeed Venture Partners to be around $580 billion at the end of 2022. Well, oil prices are on track for a third week of gains in the wake of OPEC's shock production cut on Sunday. Energy markets moved higher on the announcement, but a drop in U.S. oil inventories is now leading to a broader concern about, quote, critically low oil supplies. For more on This Week in the Commodities Markets, let's check in with Jared over at the Wi-Fi Interactive. Jared?
Yes, well, as it turns out, crude oil just about break even for this short week here. Here's what it's done today. And let me just give a year-to-date look. And we can see there was a big pickup here and some volatility recently. This has to do with the OPEC Plus decision that came over the weekend. A bit of a surprise that they're cutting production by 1 million barrels per day. And this had ripples throughout the energy universe here. Now, in terms of crude, all right, it's flat or basically up 4.5% for the year to date. But in the context, it is still relatively up in the upper, I would say, range historically going back to the beginning of the pandemic. And right now, it is punched above 80. So could be that that breakdown below the $75 price level was a false breakdown. But really what's gotten a lot of headlines this week is the strength in not only gold, but also silver. And on that measure, let me show you what's going on with silver here. Kind of a little jump to the upside. And silver really got going, silver and gold really got going a few months ago, and that would be back in here. And that had to do with a changing dynamic in the Fed's calculus and also in the bond market in the U.S. And as we're seeing real yields retreat back down, especially with respect to that banking panic, we saw movement into gold. And here's GC. Here's gold. You can see it's up 20% over the last 3 years. This year alone, it is now up almost 10%. Pretty big movement for gold. And just a reminder, as gold moves higher, its volatility tends to increase, and that's the opposite of stocks. So it's right on the doorstep of record highs. I think that record high was just short of 2,100 a couple of years ago, and we'll have to see what comes of this. Elsewhere in the news and commodities, we did see some various grain contracts flag. We're seeing corn down 5.5%, soybeans down 4%. But overall, pretty interesting to see these dynamics play out. And of course, when we talk energy, we're talking gas prices as well. So we're going to be monitoring this situation going forward, Brad.
All right, good stuff there, Jared. Coming up, everyone, on the other side of this short break, how to invest in the current market environment, why our next guest says he wouldn't buy any stocks at this level. That's coming up. Good morning, everyone. You're watching Yahoo Finance Live. Brad Smith here with Jared Blickery. We're taking a look at some of the latest market action here as we're just about 33 minutes into trade on the day. The S&P 500 past 4 days net lower by about 0.75%. Here today, you're seeing that down by about 0.3%. The Nasdaq Composite tech-heavy average, that's also lower over the course of today's activity and adding on to this week's declines that we've seen. Some slippage here on Isle Tech, seeing declines of about 2.25% there. We'll round that off too. And then the Dow Jones Industrial Average. Hey, we've got some green on the screen over the past 4 days at least. However, right now it's down by about 0.4% in today's session. So where is most of the lag coming into play here on the 11 S&P 500 sectors intraday at least? We'll pull that view up for you and then we'll kind of pull it back to a week to date for you. Utilities, that's leading the pack here on the day. You're seeing that up by about about 0.3 or 0.25%. Industrials, you're also seeing a bit of a bite there, but it's flat, just barely to the upside here. But more laggards than advancers as of right now. You're seeing some move lower here in consumer discretionary. That's down by about 0.9%, leading some of the declines. Perhaps some of the data from the retail sector over the course of this week really weighing on that sentiment there. You're also taking a look at tech there on the day. That's down by about 0.6% here. And then just kind of a view of the past 4 days, and we've got some deep declines in industrials and consumer discretionary. You're seeing that in deep declines over the course of this week by about 4%. So tough week there for consumer discretionary. Let's take a look at the Nasdaq 100 over the past 4 days. You do have some deep red in the form of Tesla, and that coming off of some of those delivery numbers that we got earlier this week. A lot of news in the EV space, but intraday here today on this final trading session of this week, you're seeing a lot of red here on the screen for the NASDAQ names as of right now, Jared. More laggards than advancers on the NASDAQ 100 at least.
Yeah, a little tough out there for traders, and 2023 off to a lousy start for stock pickers. Most actively managed mutual funds took a hit in the first quarter after bank failures and tech reversals, and this is according to Bank of America. So where does this leave investors? Here to discuss the cautious landscape in the market is Tasty Trade CEO Scott Sheridan. Scott, thank you for joining us today, and just get your big picture overview of what we've seen in the markets this year and your opinion of where you think we're going here.
Yeah, good morning. Thanks for having me. So there's not much here that I'm going to say is a big surprise. I think we've been in a range we're topping, except for at these levels, I'm just a bit cautious. You know, it's a handful of stocks that I'm looking at that to me say more potential for the downside than the upside. But I want to preface this with saying nobody knows anything. So when you hear the quote unquote experts say, be careful of inflation or recession or interest rates, I take that with a grain of salt.
I think, you know, we've all learned from a lot though, right, as well. And so even if we're kind of trying to look to what's taken place to at least give us some type of inclination as to where investors may place more weighting in their portfolio or where we may even see some shifts in that portfolio. You know, as of right now in the early activity over the course of this year, one of our guests earlier was bringing up that, you know, this may not be the type of recovery that we thought was in the tape or we thought was at play, but more so just a bounce. What's your perspective there?
So I think we've had, unfortunately, and I say that very seriously, we had a 14-year period where nothing mattered. We just went up every single day. And I think what we're now seeing is we're coming back to reality. And this is what markets are supposed to do. You're supposed to have chop. I know that most retail just wants straight upside because it's great. Most retail is just long. So if you're just long, you want your stocks to go up. What we have seen for sure is a rotation on the retail side away from individual names because there is too much chop right now, and moving more towards broad-based like the S&P, so the SPY, for example. What I think is going to happen is that trend is going to remain the same for some period of time until we do get a base. And I don't know if we're making a base right now or if we're going to be heading significantly lower. You know, my feeling is if we were to drop another, 500-600 points in the S&Ps, that would not alarm me whatsoever. Overall, the market is going to go higher. The question is going to be, is it next week, next year, 5 years from now? So for me, what I think the bigger concern is that there is a large percentage of retail traders, retail customers who have never really seen a massive down move, which we've had a significant down move over the last year plus. interest rates have definitely caused, slowdown in trading and a pullback in the markets. As you just said, VC funding is off dramatically. I think you said 56% year over year. And I just read this morning that bond issuance is down at its lowest levels in the last decade. That's telling you that there's concern out there, which I don't think is overall is good for the stock market. We want, all the wheels greased and everything running smoothly. That's not happening right now. There is uncertainty and volatility. The VIX is telling you, the VIX is telling you hanging in the 20, 21, 22% level. It's a big number for the VIX. That's historically over average. And, I think for me, this is going to continue for some, for the foreseeable future. I'd say at least for the rest of this year, and we'll see if it goes into 24.
Scott, are the retail traders sticking with it, though? And I guess that's my question to you, because you've been in the brokerage business for a long time. A parallel that I've been looking at more closely is the 2000 to 2002, arguably 2003 bear market in stocks that lasted, well, let's see, we're about a year and a half into this one. That lasted twice that, or at least that. And in that case, I remember 2004, 2005, traders had largely abandoned risk markets and trading had become quite boring at that time. What's the risk that traders who haven't experienced this type of drawdown or get worn out and just leave the game altogether?
Zero. Retail traders are here to stay, and I think it's amazing. I think it's great. The access to markets is significantly different for retail than it was what the period you're talking about, and I traded in that period. It was a very different environment. So you have retail as a much larger percentage of the options market, stock market as well, but the options market for sure. So if you look at OCC volumes, you look at what the percentage that retail is putting up on a daily basis, that's not going to change. The overall market is slower for sure. You're seeing volumes at the OCC. We were having 50 plus million days. Now they're 30s and 40 million. So there's a pullback, but that's okay. Doesn't concern me at all. I think retail is here to stay, and I think it's great because retail should have the opportunity to be involved in the markets and have control of their financial future and their financial freedom.
Do you believe that with the surge of retail traders that we've seen over the past 2-3 years overall, do you think that that's focused now in this environment more on trying to squeeze some of the shorts, or is it more focused on names that they personally feel some annexation to, that they know the businesses of, that they themselves are purchasers of and believers in the management team?
I hope the latter. What we saw with the former, with the squeeze, with the meme craze, I believe it was once in a lifetime. It was amazing. And it really was something. I think it was a 6 standard deviation move, something you're just not going to see again. So I hope that as people participate in this, they have a reason. So I'm not as big, and I think if you want to invest in something that because you use the product, that's great. But I also think that retail, there's so much education out there that's available to retail, really good education. And retail has the opportunity to get involved in a way and at a level they just haven't been able to in the past. So if people want to take this seriously, which I think most do, and unfortunately you hear stories, and the stories are the ones that make the press and people go, it's bad, retail shouldn't be doing this. Completely disagree. There's going to be issues, in any situation. But in this case, I think if retail wants to continue to be involved, which I think they will, they're going to become smarter, better, more sophisticated. And I don't believe that there has to be a us versus them, meaning retail versus Wall Street. I don't think that has to be at all. I think both sides can live and play very nicely together.
Well, retail certainly likes to talk their book and talk their portfolio a little bit, well, almost synonymously, like some of the larger institutions as well. Scott Sheridan, CEO of Tasty Trade Brokerage. Thanks so much for taking the time here with us today.
My pleasure. Have a great day.
You too. Switching gears, everyone. Tesla CEO Elon Musk reveals the third part of the EV maker's master plan is to lead the global effort to convert the world to sustainable energy here. And as part of that, according to Musk, Tesla's projects will take $10 trillion in investments. But the CEO notes the alternative of continuing to rely on fossil fuels would cost roughly $14 trillion here. Shares of Tesla, they certainly have been in focus and in the news over the course of this week, even as we think about some of the delivery numbers that have come out from automakers. But When we got the presentation from Tesla executives, that was largely seen as somewhat lackluster or lacking details, at least, in terms of how they were going to hit some of their financial goals on the back of the more sustainable and environmentally friendly goals that they have put forth that really emanates through the very product that they are trying to put in people's homes, garages, in their driveways. At the end of the day, it's more of those details as to how they're going to reach that will appeal to investors. But I think for a lot of how the EV market has changed over and the automotive landscape has changed over, it's because Tesla has tried to make electric vehicles sexy, and it's succeeded in large part for that. But now it's how do you continue to prove profitability to investors too?
Well, and being price sensitive, and Tesla has shown that they have the ability to slash their cuts or slash their prices while not affecting their margins as much as some of the legacy auto carriers, and I think that's key here. But this is a 20-year prediction. This is a 20-year problem. Do we really think we know what the world is going to look like in 2046? No, and there's all kinds of back-of-the-envelope computations that are going on here to reach these numbers. But once you get the population, once Elon Musk introduced the sexy element to the EV world, and once he got the price down enough, I think it was fait accompli that we eventually converge or emerge in this pure EV world. Now, a couple of demographics you're going to have to get on board. The truck drivers, you go to the south, I don't think you're going to see F-150, the electric ones dotting the landscape there. The Lightning, quite as much as you would in the north. But it might take a decade or 2 decades to drag people kicking and screaming, but it's coming. Yeah. It's coming.
It's here too.
Yes.
It's just the fact that it's 6% EV sales right now of the total auto market right now. So
a lot to be disrupted.
A lot to be disrupted, and a big timeline as well. 20 years, as you were mentioning.
Yes.
My crystal ball operating system needs to be updated.
I got the next 5 minutes covered.
Gotcha. Also, we got to talk about Constellation Brands here this morning. They're out with a beat on earnings estimates in its latest quarter. Comparable net sales slid, though, 5% year over year. And while the company increased its quarterly dividend, looking ahead to guidance for fiscal year 2024, the American alcoholic beverage manufacturer failed to meet analyst estimates for operating cash flow and free cash flow. Shares right now higher by about 0.5%. Coming up, the future of blockchain. Why our next guest says that we are approaching an inflection point. That's next.
Credit default swaps, or CDS, back in the news, evoking memories of 2008 and the global financial crisis, as well as a Big Short movie, but we're talking about today. A CDS contract amounts to an insurance contract on a bond or a loan to protect against the risk of default. That's the credit and the default part, but we want to talk about the swap part as well, and that refers to the exchange of payments or cash flows between the buyer and the seller. Now, when the contract is initiated, the buyer will make an upfront payment plus maybe quarterly or annual installments, and the seller is only responsible for payment in the event of default. That is a credit event. It could be a missed payment on the bond, or it could be the company filing for bankruptcy. Who uses CDS? Probably not you and me, but large institutional bond managers with millions of billions of dollars invested, they of course want to hedge their risk in the market. And for you and me, quite helpful to know what Wall Street is watching and what keeps them up at night. The blockchain may not be moving investment-wise at the speed of AI or the metaverse, but its potential for the future is unmeasurable. In a recent note from the city, they highlight the potential for tokenization via blockchain, and that could reach nearly $5 trillion in value by 2030. And for more on this, we welcome in Ronit Ghosh, City Head of Future of Finance, Citi Global Insights. Thank you for joining us here today. So just broad strokes here. I remember the whole blockchain craze of 2018 or so, when anybody who appended the name blockchain, if they had a stock ticker, instantly it would go to the moon. But we haven't seen that as much recently. Where is the technology now?
Sure. Viewers will be rightly skeptical about blockchain. We've been waiting for years. ChatGPT came along at the end of last year, and in 15 minutes, probably got as many users as blockchain got in 15 years. We think this is going to change in the next 2 or 3 years, and that's what our report is about. Money, token, and games. What we argue in our report is that blockchain is about the transfer of value, money, assets, similar type of things. And in most parts of the world, including the US, this is regulated. And what's going to change in the coming years is that regulated institutions are getting involved. Big buy-side institutions are getting involved in the space. That's one change, and that's going to come out of the US primarily. The second change coming out of Asia is the next generation of games. So fun, social. We're going to see gamers, native gamers, coming up with games with Web3 components, blockchain components. Not crypto guys, not crypto bros saying, hey, I want to build a crypto game. This will be taking hit games that exist, initially in Korea, Japan, and then the rest of the world, including the US, getting hit games and dropping in tokens. That's what's going to change, we think, in the next couple of years.
I mean, we're talking about an opportunity where Insight Partners has forecasted that global blockchain's market size will be worth $227.99 billion by 2028. What is the monetization of that for companies who are putting out public blockchains versus a managed or private blockchain? What does that pathway look like right now?
Sure. So let's think about the use cases of blockchain. So in finance, in money, digital securities. So if you're building a public or a permissioned version, like a private or semi-private version of your blockchain, you've got users now, big institutions saying, hey, can I try out your chain? And that's different to 5 or 7 years ago. And why are they saying it? They're saying it because they want to appeal to a new client base. If you're a PE firm or a VC firm, you're probably close to maxed out when it comes to some of the institutional investors, particularly in the US. If you're an endowment fund at a university, yeah, you've heard about this VC thing and this PE thing decades ago. Where they want to target is the retail, but particularly the higher end of retail. You know, you've got a few $1 million in the bank, in savings, but the ticket size of some of these investments are 3 million, 10 million. You're wealthy, but you can't access these products. What tokenization, what blockchain allows you to do is at a lower price, get these alternative asset and alternative investment products out to a range of folks, you know, middle-class folks with 6-figure balances, low 7 figures, but not like ultra high net worth individual. And that's what the buy side's focused on.
And talk to us about tokenization. That's one of the aspects that I feel is really interesting here. Everything from watches to real estate. And we saw this take off with the rise of NFTs. But the timing, of course, we saw a huge drop off in Bitcoin prices, Ether prices, and the timing was bad. I'm just wondering, where do you see tokenization going from here? And do we see the rise of NFTs once again from the ashes?
Sure. So underlying NFTs, the technology of tokenization is really interesting. Obviously, like all innovations, and we can go back to the growth of the railways in the US and the UK, new innovations come with bubbles, hype cycles, speculation, sometimes unfortunately scams. We've seen that with the railways, we've seen that with international trade in the 1600s, 1700s, railways in the 19th century, the first dot-com wave, and we've seen that again most recently with the some of the more scammy NFT projects. Tokenization is a technology that can be applied to almost anything. In the report, we interview some folks who specialize in fine wines. You want to buy a fine wine, but necessarily you don't want to consume it now, or it could be a fine whiskey. You can tokenize it. You can have it's like having the digital asset. You have the receipt and say, this is mine. And then you can sell it on. And that wine or whiskey sits in a warehouse somewhere. You never see it. Same with art. You say, look, this Picasso is really interesting, but guess what? I don't have 50 or 100 million bucks to blow on a painting. Maybe I can own a fraction of that. And so whether it's art, fine art, wine, any collectible, watches, you could tokenize. Obviously, real estate.
Ronit, you had me at fine whiskey. Look, at the end of the day, I just got to know, for everything that we've been discussing with the blockchain and how this can be layered into the existing financial technology infrastructure, we've already seen a hit to some sentiment around the banking runs that have taken place over recent weeks here. How does the blockchain remove some of the risks that have become known on a management side, but now reassure people in how they can bank and how they are engaging with financial services and industry leaders who manage their money?
Sure. Blockchain is simply a technology, and you can use it for good or bad. Now, if you're technologically savvy today, you can self-custody assets, financial or otherwise, using crypto solutions. Over time, and we call this, like many analysts, Web 2.5, what you're going to see is these solutions, these Web 3 solutions merging with Web 2 interfaces, so we can get it out to way more people. Up to recently, the average, say, middle-aged guy like myself hasn't really used these technologies. Obviously, when you get to younger demographics, there's a much higher level of penetration, knowledge, awareness. You go to a college campus versus you go to a golf course. It's a very different type of knowledge and awareness of these technologies. But what will happen in the next few years is that we're going to see this continuing spread through existing large institutions. So think of the gaming example I used before, saying, if you've got your existing hit game studio, game platform, your users know you. You drop in an element of blockchain into that to make the game better. It'll be the same when it comes to money.
Understood. Citi head of future of finance, Citi Global Insights, Ronit Ghose. Ronit, you mentioned golf. We're going to have a little bit more golf talk here. So, maybe just stick around, or at least keep the Zoom or the Skype feed loaded up. You'll be able to hear some of that. We appreciate this conversation, though, on blockchain here this morning. Appreciate it.
Thanks for having me.
You got it. Guys, coming up, the tech sector was rocked by layoffs this year, but other sectors remain safe. What this means for the state of the labor market, that's on the other side. Despite headlines from mass tech job cuts, layoffs overall decreased slightly in February and have remained historically low. But when headcount needs to come down, there's an alternative to mass layoffs: paying your employees to leave. Joining us now to explain, we've got Yuri Nizi, who is the chair over at UC San Diego's Rady School of Management and author of Mixed Signals. Okay, all right, break this down for us. Paying people to leave. Who has done this before? I mean, Amazon has been perhaps one of the most noteworthy companies that's at least tested that over an extended period of time, then scaled it back. But where else might this be applicable?
Good morning. It's great to be here. So the value, your value, and my value depends on how motivated we are, how happy we are to actually be at our workplace. If you come on Monday morning or Thursday morning, like today, early in the morning to the job and be really like, well, I don't want to be here, your value is not going to be great, no matter how talented you are, how good looking you are, and how deep your voice is. So we need to know as employers, as managers, what they need to know is how motivated you are to work. But it's very hard to know. If I just simply ask you, look, how motivated are you? You'll tell me that you're very motivated. That's not a very reasonable or good way of learning this. And in many cases, we can't really judge how good someone is at their job because we observe a teamwork, we observe something that we'll see only in the long run. So it's very important to actually get this right, how motivated people are. And just simply asking them won't work. One way that companies like Amazon, as you said, used is something that is called pay to quit. I'll try to get your motivation level using incentives. So here's how it goes. Say that I offer you, you know what? Here's $10,000 if you leave us today. Yeah, you're welcome. But you have to leave your job for that. No. Right? So I'll give you $10,000 and then you'll go and everything will be good between us. Right? So that's a good way to actually get the people that are less motivated. Why? Because if you're motivated to work for me, you'll say, no, thank you. I actually enjoy working for you. I don't want to go. And if you are like on the fence, you're ready to go already, but you wait for something to happen, then you'll just say, no, thank you, I'm going to stay. And this way you can really separate the people that are fed up and ready to go. They might have been great employees 5 years ago when you hired them, but now they are not anymore. You can get the less motivated people out of the door. They'll be happy, right? So it's not like firing someone. It's not like firing, which is a very unpleasant thing to do, I guess, right? So you really get the people that are less motivated. They live in a happy way. And the people that you keep are going to be actually probably performing better because now they'll have to justify to themselves that, why did I give up this $10,000? Right? So I probably really like this job and they're going to invest much more effort.
Yeah, you could call it sunk costs or sunk opportunity costs there. I really like the idea of using incentives to nudge people in certain ways, whether monetary or otherwise. And you give a really interesting example. Let's say I'm an employer. We're over the pandemic now, and I want my employees to return to work, say 3 days a week. Well, a lot of them might protest, but there's another way I could potentially frame this that would be perhaps more motivating to them.
Right. So basically what I do is look at how incentives change the story. Incentives send a signal about what's going on, and you figure out from the incentive what's the story. We get lots of information, and we need to make a story out of it, and incentives really help us with this. So imagine two scenarios. In one of them, the company tells the people, look, the party is over, the pandemic is over, we all need to come back to the office. Instead of 5 days a week, you'll have to come for 3 days a week. People are going to be very upset because they see it as a punishment. Now they have to come back to the office for 3 days a week. Imagine the alternative. I'll tell you, look, the pandemic is over. We have to come back to the office. But because you were so nice and you behaved so well and you worked so efficiently, we're going to let you work from home for 2 days. Exactly the same outcome. You come into the office for 3 days a week, but a very different story. Instead of we are punishing you now by making you come back to the office. Instead of that, we are telling you, look, we have to come to the office, but you're so great, so we're going to give you 2 days off. Okay. Off of coming to the office, right? So exact same economics, very different story. That people.
Do you see a future where this pay to quit strategy will replace severance and severance packages and costs there that we've seen amount for companies?
Right. So I think that that's not going to be good for every company. There are companies in which you can simply observe the output of people. So if I can observe, if you work on a line making T-shirts, I can really count how many T-shirts you're producing, and then I can reward you based on that. So we're talking about a sector that it's very hard to know their productivity, their immediate productivity. So over there, I'm going to see much more of that. And yes, I think that smart companies will use that instead of firing people, getting people to be unhappy about it, which has long-term impact. You can really select the people that want to work for you. And that's extremely important. So I really suggest using it.
All right, we have to leave it there. Really appreciate your insights here, and made me think about a couple things. And
no, you can't go anywhere.
I can't go anywhere.
You got to stay. You got to stay.
All right. Well, we definitely thank you for coming here, Yuri Nizi, author of Mixed Signals. All right, coming up, how U.S.-China tensions could impact global output. Rick Newman has all the details up next.
As we head into bank earnings, there's a phrase you're probably going to hear a lot of. It is net interest margin. So we want to tell you exactly what that means. It's the difference between the interest that a bank pays out and what it brings in. So in other words, a bank takes in deposits from you, from companies, and it pays interest on those deposits. So that's the money that it pays out. Then it also loans out money to you, for your home, for example, to businesses, and then it collects interest as a result of lending out that money. The difference between those two numbers, that is commonly referred to as net interest margin. So in other words, if I'm depositing my money in the bank and collecting 3% interest on that, and then also if I am borrowing money from the bank for whatever it may be, and I'm paying 7%, say, on that loan, the difference between those two, 4%, that's the net interest margin. But to get a little wonky for a second here, the technical definition then takes that number and divides it by the average earning assets at the bank. All that means is all the other stuff on the balance sheet that doesn't really move around that much, stocks, bonds, etc. That's where you get the net interest margin. It's also especially relevant right now with a period of rising interest rates. Why? When interest rates start to go higher, more people want to put their money in savings at the bank because they're getting actually some interest on that for the first time in a long time. And maybe fewer people want to borrow money because it's more expensive to do so. So it's particularly relevant right now, and we're going to hear a lot about it once the banks start reporting.
The International Monetary Fund, or IMF, has released a new report on how deglobalization could set back the global economy. The institution warning in its report that increasing tensions between the U.S. and China could cost the world 2% of its GDP. For more on the IMF's warning, let's go to Yahoo Finance's senior columnist, Rick Newman. And Rick, your take on this, the latest.
Yeah, they're pushing back against this whole, I mean, it's not really a concept, it's actually happening. The reality of deglobalization, which they call slowbalization, in quote marks. It's this idea that the United States and other countries, Europe, they're trying to spur more domestic production. We've seen this in the Biden administration in things such as the CHIPS Act from last year and other policies. And there's clearly growing tensions between the United States, partly over military and national security concerns. So what the IMF is saying is this will actually produce inefficiencies that will cost the global economy some level of growth. They're actually saying this will hurt emerging markets more than it will hurt developed economies such as the United States. But nonetheless, this is sort of an economic way of looking at deglobalization and saying, look, there are some costs to this. Even though it might be politically popular, there are some costs. Now, I would point out that this whole notion of decoupling between the United States and China is a little bit overstated. We still have massive amounts of trade with China, and much of the stuff Americans buy on Amazon or at Walmart still comes from China. So those goods are still flowing in. But look, we've seen a series of things here. The Trump tariffs on Chinese imports from 2018 and 2019, more subsidies for domestic production here in the United States, trying to bring some supply chains back to the United States, especially after COVID. And then new export controls from the Biden administration on high-tech sales of U.S. technology to China, all pushing against globalization. So there will be some cost to this.
And Rick, the part of the deglobalization means in part an end to cheap energy for certain consumers of energy, notably in Europe. U.S. basically energy independent, net. But over in Europe, with the war in Ukraine, that sparked new concerns about their energy independence, and they're paying through the nose with heavily subsidized government rates still. This kind of changes the input costs and the supply and demand dynamics for their exports. And just wondering how energy really fits into this whole theme of deglobalization that you're talking about.
Giant changes in energy flows during the last year and a half. A lot of that comes from the Russia's invasion of Ukraine and the cutoff of Russian energy supplies to Europe, but many other things also going on, Jared. I mean, the Saudis and other Middle East nations now are turning more toward China as their main customer rather than the United States, because the United States is producing so much more energy than it did 10 or 15 years ago, and China needs it. So, actually, I'm not sure we have deglobalization of energy because so many countries need energy from new sources. I mean, one of the biggest developments in Europe in the last year has been trying to find new sources of energy. Some of that has come from the United States. Some of it has come from the Middle East. Some of it has come from Australia. Some of it has come from Europe itself, such as Norway. And this is going to continue. So we have seen a remaking of global energy flows during the last year. And I think most energy analysts think that is going to continue.
Yahoo Finance's own senior columnist, Rick Newman. Rick, thanks so much. We appreciate it.
Bye, guys.
Definitely. Coming up, DraftKings is riding the highs of legalized gambling so far this year. We're going to speak with an analyst from Oppenheimer on the state of sports betting and the Masters. Let's be real. We're talking about the Masters. It's coming up next. DraftKings, ticker symbol DKNG, has kicked off 2023 on a pretty high note. You're taking a look at some of those gains on the screen, up by about 55% over the course of 2023, with legalized sports betting on the rise. And as gamblers recover from March Madness, another big event on the horizon here and now. The Masters tees off, and we're joined by Oppenheimer senior analyst Jed Kelly, plus Golf Digest staff writer Christopher Powers. Great to have both of you here with us today. Jed, first and foremost, just take us into some of the betting activity that we've seen over the course of this year and what names like DraftKings are really being able to capitalize on.
Yeah, so I think we've had pretty robust betting activity to start the year. NFL playoffs were good. March Madness was significantly better than last year, although UConn winning probably wasn't the best outcome for the books, and now we're into the Masters. I think really you mentioned DraftKings being up, 55% this year. What's really driving that is we're seeing improved profitability throughout the industry. You're starting to see the land-based players like BetMGM, Caesars pull back, and DraftKings is really able to start to show profitability. So we think that's what's driving the stock, and more states legalized, and you now have an event like the Masters that's able to engage more bettors.
Chris, I'm not going to put you on the spot and ask for a pick to win, but I will ask you, since you were there at Augusta and where the Masters is taking place for this weekend, what the vibe is. Give us a vibe check of what's taking place down there. I mean, ultimately, this is the first time that we're now seeing PGA Tour players, some of the biggest names, now re-engage with some of the live golfers who defected over to that tour and are able to participate in the Masters tournament. What is the vibe there, boots on the ground?
I would say more than cordial. It is Augusta National, so everyone's kind of falling in line and getting along. So to say the Champions Dinner sounded like it went quite well. Everyone's just trying to get along, as they say. Apparently, though, Phil Mickelson was a little bit quiet at the Champions Dinner, not usually his talkative self, but overall, very strong vibe. Sun's out today. Some weather rolling in here Saturday, I believe, but looks like we're going to play golf today. Tomorrow, hopefully Sunday will be very nice, and we should be able to get this thing in 4 days.
And Jed, want to go back to DraftKings and FanDuel, that battle. And in your latest note, you say FanDuel is rapidly gaining share in new state launches. And you were just talking about some of the competitive nature of DraftKings. And then posing the question, can DraftKings catch up? Your answer to that, please.
Yeah, so what we're seeing is FanDuel's really benefiting from Flutter's 2-decade of trading and promotional experience, and they just have a high amount of promotional sophistication. I live in Massachusetts. That state went live last month, and we're really seeing Flutter use a lot of this promotional sophistication to engage bettors and actually drive them down the parlay funnel and do better parlay merchandising. And as you know, that's where the better higher yields are. We actually think this is a good roadmap for DraftKings, because FanDuel is proving that you can actually generate higher yields from customers, engage them, and be able to actually increase your revenue per customer. So we think DraftKings has the capabilities to catch up. We actually think their parlay product is pretty much on par with FanDuel's. It's just, how do you merchandise that customer? How do you engage that customer? And sort of once you kind of take over more of your same game parlay, can you do more merchandising to get bettors more engaged?
Speaking of some of those bettors, Chris, I mean, one of the huge thought processes that many bettors have to think about with regard to the event this weekend in the world of golf is the fact that you do have, as we mentioned, some of those live golfers coming back together with the PGA Tour golfers, and it now being on the table of, all right, do I take a player that is not necessarily ranked in FedEx Cup points or that I haven't seen play as much, or do I take the person that I know to be world number one in Scottie Scheffler? How are people kind of gauging that from the conversations that you've had? Or on the other side, of the live golfers that are participating, do any of them look bet worthy right now?
Yes, absolutely. Obviously, Brooks Koepka just won the live event in Orlando this past weekend. Patrick Reed played pretty well there. He's a former Masters champion. I actually made a bet on Patrick Reed this week. He's off to a pretty good start. I would say a lot of bettors did flock to Brooks Koepka. We saw him open at around 70-1, and then he won the live event and literally got cut in half to 35-1, and people were still betting it anyway. He's got great history in the majors. So I would say people were very high on a lot of guys this week. But yeah, that group that's on the screen right now, Scotty, Rory, Rahm, Spieth, I'm on Finau. Yeah, it's everyone's on the live guys, but yeah, I would probably lean with Scheffler to go back to back as tough as that is. That would be some serious history. Only Nick Faldo, Jack Nicklaus, and Tiger Woods have accomplished that feat. But to go back to your original question, people are very high on the live guys. Actually, one live guy just withdrew, Kevin Na. Tough start to the week for him, but so far so good for all the other guys coming over from the Saudi tour.
Chris, another question at you here, and forgive me if this is just too basic, but what does golf, the sport of golf, look like without Tiger Woods? We've seen him leave on an interim basis before, and when he comes back, there seems to be a sigh of relief that finally the main attraction is back, selling tickets here. What are some of those other players on the screen that I was just looking at, whose names I don't necessarily know? What are they adding in terms of value to the sport right now?
Well, a lot of them, like a Scotty Scheffler, just a, almost offensively nice type of guy. A lot of these younger guys are extremely nice, not too controversial. And then obviously Tiger comes, and the place is packed this week. Phil's here as well. But yeah, it is tough to not have Tiger on a week-to-week basis now. We're going to see him maybe 4 times a year and one other time at Riviera, his event in California. And if we're lucky, maybe one other event. So you've really got to cherish these weeks as a golf fan. But I do still think the PGA Tour is in pretty good hands with some of these young stars, like a Scotty, like a Jordan Spieth, who's playing very good golf again. We've seen Rick Heller start to play very good golf again. He's a huge fan favorite. So we need more guys like Ricky at Jason Day, as well as kind of found some form again here. So I do still think the tour is in good hands, even when Tiger Woods is not playing on a regular basis.
A lot of our viewers have seen Jared and I sitting here talking about the markets this morning, but I can neither confirm nor deny that at 10:18 a.m. Eastern time that there was Tiger Woods on my laptop here on the desk, at least for a brief moment, but won't confirm or deny that. Jed, while we have you here, just as we think out to the rest of this year, what are some of the major catalysts that you're going to be looking for? I mean, of course, events like the Masters, events like March Madness, major acquisition opportunities for some of the larger kind of sports books and digital apps that have made their way into the fingertips of bettors everywhere. But where do those opportunities continue to come about, and how are you going to be watching for some of those customer acquisition costs to begin to or continue to retreat?
Yeah, so in regards to catalysts, I think we're still watching state launches. North Carolina looks promising. Missouri looks promising. Kentucky just went legal last year. So, even if those states aren't all live by football season, you have a pretty good roadmap into 24 that presents a pretty nice profitability trajectory. The one thing to watch is just what goes on in Texas. It does look like the 3 big states, Texas, Florida, and California, at best, one of them might be live by 2025, but to be decided. And in terms of that customer acquisition, I think you're just going to see a favorable environment throughout the rest of the year, right? What you've seen is, I think you've seen the investors for MGM and Caesars basically tell management, hey, we're all right with you guys being 5 to 10% market share gainers in sports betting and letting DraftKings and FanDuel consolidate the rest of the market. So that's what we're watching. And then the one thing to watch, I guess, with DraftKings from a product perspective is, they do have the toggle on their same game parlay. My guess is, that would likely be going away sometime around football season, but that's what we're watching.
Gentlemen, thank you so much for the time here. Chris, a little tidbit that you can use in your reporting over at Golf Digest as well. My desk mate here, Jared, just flagged that the stocks high of the day here for today's session was at 10:16 a.m. We all know what happened 2 minutes later. Tiger Woods teed off in Augusta, Georgia at the Masters event. So you can take that as you want. Productivity may slip up a little bit here on the day. Final trading session of the week. Golf Digest senior writer Chris Powers and Oppenheimer senior analyst Jed Kelly. Thanks so much for the time, guys.
Thanks for having me.
Absolutely. And coming up, stay tuned for our 3 to 5 show. Shauna Smith and Dave Briggs, they're going to continue our coverage of the aforementioned Masters and how it's impacting golf stocks. Stick with us. Welcome back, everyone. We've got some great interviews lined up all day at Yahoo Finance. Rochelle Akufo is going to speak with the analyst behind the latest Meta upgrade in the next hour, who called it the year of efficiency for Zuckerberg's empire.
Plus, the fall of commercial real estate, why the street is predicting it will be worse than the great financial crisis. Rochelle will speak with a panel of experts in the next hour.
And stay tuned during the 3 to 5 p.m. hours. That show is going to have Shauna Smith, Dave Briggs. They're previewing tomorrow's jobs report with the Conference Board Chief Economist Dana Peterson. You do not want to miss that conversation. All that and much more Rochelle Akufo has you for the next hour of trading. Stay with us. Here's a live shot of New York.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo, and here's a look at what I'm watching this morning. It's been a story of the haves and have-nots for the markets so far this year. Sure, the S&P 500 is up 7%, but what about the average stock? It's barely hanging on to 1% gains, and these narrow rallies don't usually last. We'll explain. Meanwhile, stocks may not be as attractive, but bonds are back in business. Investors are reaping the rewards of owning bonds. We'll tell you exactly how to play yield in this volatile environment. And finally, the fall of commercial real estate. Moody's warning that office buildings built before the 1980s will likely become obsolete. And Morgan Stanley forecasting something worse than the financial crisis. We'll get a pulse of where things stand in the industry. But first, let's give you a check on where markets stand an hour and a half into the trading day. We see that some of the stronger selling action is starting to ease a little bit off the session lows. The Dow, though, still down about 117 points on the day, about 1/3%. S&P 500 also down about 1/3%. Tech-heavy Nasdaq also down about 26 points there after weekly jobless claims came in higher than expected, a sign that the Fed's interest rate hikes are really slowing the economy, fueling some of these recession fears and investor expectations for a potential rate pause coming up at the May meeting. Let's also check in on the Treasury market then, as we see the VIX ticked up there to almost 20 at this point, seeing this flight to safety. The 5-year, as we see, they're down about 0.25%. The 10-year also down just very slightly, about 0.1%, 0.2% there. The 30-year longer-term yields there seeing losses of 0.5% on the day. Right, turning now to our top story on the markets, we're watching a few big stocks driving the current rally. But as the set names behind the market move narrows, is the tech-driven shift sustainable? Joining us with more, Yahoo Finance's Jared Blickery. Hey, Jared.
Yes, concentration risk. This is something that I remember hearing years ago in the lead up to the global pandemic, and we'll get to that in a second. But first, here is a chart of the S&P 500's largest two stocks and how much they're contributing, how much they make up in the index. This goes back all the way to 1975, and back then there were two stocks that were dominating the action. It was Ma Bell and Big Blue. AT&T and IBM. Well, fast forward, you can see we got concentration issues rising in 2016, 17, 18, leading into the pandemic. And then in the pandemic recovery, it was really all about a lot of the mega caps and those growth stocks that require low interest rates. So let's pivot now to see what's happened this year. In the Nasdaq 100, we've seen some incredible gains, especially by the mega caps here. And this was meanwhile while the Dow was barely making traction, while small caps were barely making traction. But you can see NVIDIA up 83%. It was up 90% at the end of the quarter. That was only 1 week ago. Apple up 26%. Meta up 75%. Some incredible gains. So people are wondering, will this continue? Well, historically, when you see this kind of concentration, usually only lasts for a period of time, a limited period of time. That's because if you only have some big names holding up the market, once they get whacked, the bottom falls out, and then you have some real selling. What's happened over the last 4 days, and that's this holiday shortened week, we're seeing a lot more red than green. So the conditions that created that outperformance by the mega caps, not necessarily continuing in this new quarter. And what are those conditions? Well, it gets back to the bond market. And here's where we want to take a look at what the 10-year T-note yield has done. Here's what it's done this last 4 days. It's down, but over the year, we can see it had a big drop in the early March all the way to that banking crisis that unfolded into the middle of the month, and then towards the end of it. Lower interest rates generally support higher prices in these growth stocks and the mega caps, but we're not seeing that right now. We've seen a rash of economic reports that have disappointed to the downside, and the market reaction has been, well, we don't like that either. So if we are getting into a situation where bad news is bad news, and even lower rates cannot help the growth stocks as much, that is certainly troubling for this one asset class that has really outperformed this year. Rochelle.
Indeed. Jared Blickery there for us with that update. Well, the tech-driven rally might be a sure thing as the rise in mega caps helps lift the sector, but our next guest says not to lose sight of the smaller players helping keep the tech rally afloat. Joining us now, Eric Jackson, EMJ Capital founder and president. Good to see you, Eric. So I want to get your take on this rally here, because you say we could be at the beginning of a 10-month rally, which is going to benefit tech the most like it did in 1981. So we'll get to your longer-term picks, but at least for the next quarter then, which stocks are really going to see the biggest rallies then?
Well, I think that the concentration risk that Jared was just speaking about, it gets a disproportionate share of interest. I think the reality is these huge companies like Apple, Meta, and all the rest are just, they are producing gobs of cash, gobs of profit. They are enormous relative to typical stocks. And so therefore their weight on the composite indices is enormous. And I think sometimes they can overshadow what's going on in the kind of mid-size stocks and smaller stocks. So, and there's a big difference, I would say, between them today and Ma Bell in the early 80s or whatever Jared was referring to. These companies, the FANGs, are going to continue to be successful for a while. But the mid caps and the small caps have had a successful Q1. I mean, names like in tech specifically, names like Coinbase, Tesla. I don't know if that's considered a mid cap or a large cap now. Shopify. A lot of these names have had phenomenal bounce back Q1s after a really disappointing 2022. And so even though FANGs did really well, I think you want to be thinking about what happens if this rally broadens out and starts to extend into other sectors and smaller cap stocks. And I think you want to be looking for names of companies that really haven't participated as much yet, but still have a strong underlying story. And that's where I'm spending a lot of my time and trying to focus on because I think there's further upside in those kinds of names.
And you mentioned a couple of your picks here. You mentioned Tesla, you mentioned Coinbase as well. I want to talk about Freyr Battery, the battery maker there. Obviously, this stock has been under a lot of pressure year to date. But what do you like in it long term? I know you're also looking at the Inflation Reduction Act and really the opportunities there.
Well, right. I mean, obviously, the IRA put a huge emphasis on the need to build out electric batteries and the whole electrification theme, which stretches down to even kind of the pulling the resource minerals out of the ground in order to meet the demand that we're going to see over the coming years. Since the IRA, though, was passed, a lot of other countries around the world have tried to come up with their versions of the IRA. So a week and a half ago, Canada came out with its sort of answer, which also placed an interest on electrification. Europe is going to follow soon, and they've already indicated that. And so the reality is that when you look around today and you say, wow, I think electrification is going to be important. All these car companies that are moving full steam ahead into this area, they will need batteries, which are the most costly components today to build these kinds of cars. And it's not just a car story, electrification. Keep in mind, like, we're also going to want it for our businesses, our homes. We need to store energy and so forth. If we have solar panels on our roofs and all this kind of stuff. So who are going to build those batteries? And today, the biggest players are Chinese and Japanese. And so, if you believe that there's going to continue to be tensions with China, obviously you would want to see some Western-based players producing batteries, and there just aren't a lot today that are out there. And so Freyr is one of the pure play Western-based electric battery makers that is still a de-SPAC pre-revenue company. And so it's still very, very small cap. And yet it's got a lot of momentum behind it. They are built in the midst of building a huge gigafactory in Norway. They're also, they've sped up their plans to build a gigafactory in Georgia because of the IRA. And that might actually be live before the Norwegian gigafactory is. So this is a company that, even though it's early stage, has a lot of momentum behind it. It has a real management team. It has real indications of interest in terms of big players giving them kind of offtake agreements. They have the financing. There's rumors out there in the market that they're going to continue to land further financing from a big private equity player, for example. So this is the kind of name where it bounces around a lot. It's a small cap. And so the volume is not huge, and it's only around $1 billion market cap today. And yet, if things continue to go well, if they continue to prove out the building of the batteries, it's the kind of name that could rocket ahead in over the next year. They have a competitor in Sweden that's only about 2 years ahead of them, but they're planning Northvolt that's planning to IPO later in the second half of this year, and they've said publicly that they want a $20 billion valuation.
Eric, I do want to make sure we get to some of your other picks as well. You have some interesting ones here: Rent the Runway, Bombardier, the private jet maker, and also Coinbase. Of those three, which ones do you see the biggest upside for? A lot of people are expecting Coinbase to really grab market share after FTX fell out, but that doesn't seem to be the case at the moment.
I think, we will see that it is the case that they are gaining market share. And now with the latest headlines about Binance from last week, I think that's a signal that they're, another signal that they're going to continue to gain market share. If you bet on, Coinbase being kind of the last regulated entity standing, notwithstanding their current battle with the SEC, then, and if you think that the bounce that we've seen in crypto in Q1, where all of crypto's market cap is up 45% on the year, is going to continue, then they are a natural beneficiary of that. When trading volumes are dropping, they are losing money and their stock's going down. But if market cap for crypto is increasing and retail investors are attracted back into the scene, that they're going to benefit. So I think that it's a very volatile stock, but they're already up 60% I think on the year or more. And they have a lot of further upside ahead if the run in crypto coins continues. The other names, I think Bombardier, it's a value stock. It's sort of gets forgotten about. It's a smaller cap stock, but they're one of the dominant luxury jet makers out there. Despite the looming recession, there's a huge backlog of people that want to get private jets, and Bombardier happens to sell the longest range, most luxurious, arguably, private jet out there with like a $75 million price ticket attached to it. So they are continuing to pay down debt, and that value is going into the value of the equity. So I like them.
We'll certainly be keeping an eye on them, and we'll follow back up with you, see how they do over the course of the next 10 months. Eric Jackson, there, EMJ Capital founder and president, thank you for your time this morning. Right, time now for our trending ticker. Bed Bath & Beyond proposing a reverse stock split as it tries to keep itself afloat. This according to a recent securities filing. The cash-strapped retailer hoping the measure is approved at an upcoming shareholder meeting. A reverse stock split will concentrate existing shares into fewer shares, raising their value. If unsuccessful, Bed Bath & Beyond says bankruptcy will be, quote, unavoidable. Right, coming up, stocks might be unattractive right now, but bonds have not looked this good in years. So how do you play the yields, and what should you do to diversify your portfolio? We'll discuss next. Bonds are back. Attractive yields and continued uncertainty in equities leading to a shift in market appetite for debt. Market Access says the effect is even more pronounced with retail investors who aren't the typical customer for the bond market. Joining us with more is Chris Concannon, Market Access CEO. Chris, thank you for joining me. So talk about this trend that we're seeing and how we're seeing retail investors playing the bond yields versus institutional investors.
Well, first of all, Rochelle, thank you for having me. I couldn't be more excited about the bond market. It's a unique time in history. We're coming off of one of the longest bull markets in history with yields rising. Obviously, the Fed is continuing to make adjustments to the federal funds rate, and we continue to see yields in the bond market to be at very attractive levels from a historic point of view. Whenever you have an end of a bull market, you typically see the challenges in the stock market that we're witnessing. Here at Market Access, we're one of the largest electronic marketplaces for bonds. The bond market is driven by an institutional trading community, and it's sometimes difficult for average investors to access the bond market. But today, there's more tools for the average investor to trade bonds. There's ETFs. which provide a really diverse level of bonds, a diversity of bonds in their investment. There's also separately managed accounts where institutions are actually handling the execution of bonds. So I would say today we have all the tools available for investors to engage in the bond market. The accessibility to the bond market's at an all-time high, and you have these attractive yields to take advantage of.
And you mentioned there ETFs and SMAs, the exchange traded funds and the separately managed accounts. When we are still in a period of volatility, though, does one offer perhaps better gains or less volatility than the other of the two?
I would say the SMA accounts where you're separately managed account, retail's getting exposure directly into the bond market. They are typically a buy and hold strategy. The ETFs are very attractive. In fact, the ETFs that we watched the ETFs perform during the pandemic in March of 2020, and they performed brilliantly. They sometimes actually outperformed the underlying bond market. So I think both choices, separately managed accounts or the ETFs, are wonderful ways of accessing the bond market.
And so how are you playing short-term yields versus longer-term yields?
Well, obviously, if you get a diversity of bonds in an ETF, highly liquid ETF, there's a number of ETFs on the market today, but that diversity is critical, and managing those short-term and long-terms are all done by most diversified ETFs. In a separately managed account, they obviously will also diversify your account and your exposures. So they do manage, the institutions will manage that diversity of bonds.
Now, we know you're just a few days into your new role as CEO from being president and COO there at MarketAxess. We know that you focus on expanded automated trading as well. You mentioned this obviously becoming now more accessible to retail traders. How do you see that changing the fixed income industry?
Well, right now the bond market is not as electronic as the equity market, and MarketAxess is playing a pivotal role in the future of what the bond market will look like. Through the use of technology and automation, we have electronified a good portion of the U.S. corporate bond market. We're about 20% of the U.S. corporate bond market, and we're seeing not only institutions access and benefit from our technology, but we're now starting to see retail players as well as private banks using our technology to electronically access the bond market. And we see that that market, we're talking about $120 trillion market globally. And that's just the opportunity to electronify that market is enormous. Given our position in the U.S. corporate bond market, we're seeing more and more retail and more institutional investors adopting our technology to solve their needs in the bond market.
And obviously, at some point, we're expecting the Fed to either pause or pivot. Investors seem to be thinking it's going to be happening sooner rather than later. What should people be aware of with the risks then when they're trying to get into the bond market, but really being aware of just how quickly things might change?
Well, what we saw in 2022 was a rapid increase in the Fed funds rate, and that certainly created challenges for bond investors, particularly long-term bonds held into at maturity accounts. I think given the adjustments and the predictions around the Fed funds rate and where the Fed is likely to come out, I think there's more stability in the rate environment today than what we witnessed last year in 2022.
And in terms of your outlook here, then, for how you see fixed income developing with these changes, though, as we perhaps looking ahead to a recession as well, what is the play there?
I think literally the bond market is the play, given the yields, given the balance sheets that we see in some of the investment grade corporations that have continued to do issuance throughout the 2023 cycle. I think we have very strong companies in our investment grade bond market, and the yields that they're providing will outperform most of the stock market and forecasts around 2023. The other area to look is the municipal bond market. We're a sizable part of that bond market. We're about 6% of the municipal bond market is traded electronically on MarketAxess. And the municipal bond market yields are quite attractive net of tax effect. And so there's two markets that are quite accessible. You can access those markets both through SMA, separately managed accounts, or the ETFs. There's a wide diversity of ETFs in the market today, fully accessible to the average retail.
It seems that bonds are back after a very rough 2022. Great getting your insights. Chris Concannon, their Market Access CEO. Thank you for your time this morning and congratulations on the new role. All right, coming up, Wall Street gets bullish on Zuckerberg's empire. Meta is bringing in the upgrades as analysts say cost-cutting measures are finally paying off, with one analyst calling this the year of efficiency for the company. He joins us next. Meta shares in focus following an upgrade from hold to buy amid its cost-cutting program. That coming from Argus Research senior securities analyst Joseph Bonner, who joins us now. Good to have you on the show, Joseph. So upgrading to a buy with a $270 price target. Good to see you here. So walk us through your base case here for Meta.
Sure. So Meta, announced another cost-cutting measure, a couple of weeks ago. You add that to what they did in November. So 10,000 headcount in November, 11,000 headcount this time. Taking real estate and rationalizing that, process improvements, cutting other low-priority projects. Taken all together, it's a real serious cost-cutting measure. When you look at, Microsoft and Alphabet, you're talking 5%, 6% cuts. This is a 24% cut, so it's big. It's a big cost-cutting measure. Going to save about $8 billion on their 2023 expense projections. So a serious measure in a kind of low revenue growth environment. Very uncertain revenue growth environment. Then kind of giving the market what it wants, giving it profitability, probably increased profitability and cash flow.
And you mentioned the revenue growth, something obviously that investors really honing in on as well there. What are your expectations for that? Because obviously the cost cutting isn't necessarily helping with that side of the business.
Correct. Again, we're in a tough revenue environment. Digital advertising is slow. There's that hangover from the Apple ad tracking transparency issue. If consensus can be believed, its revenue will be down about single digits this quarter and maybe down a little bit next quarter. I really am not looking for a revenue recovery until later in the year, much later in the year, and I think it'll be slow. So I think investors may be getting a little bit ahead of themselves, thinking that second half is going to be great. I'm a little bit more conservative on the revenue front, thinking slow recovery after maybe 1 or 2 quarters of negative growth.
And you mentioned some of these ad dollars here. Already tough competition at the moment, but how well positioned is Meta versus some of its counterparts? And who would you say really are the strongest competitors for ad dollars?
Right. So I think Meta actually is doing quite well in the competitive landscape. I mean, and really it has to do with, kind of stumbles from competitors. I mean, if anybody watched the testimony of the TikTok CEO a couple of weeks ago, obviously in trouble with the U.S. government. Whether that's going to be a ban or a spinoff, nobody knows. But certainly, TikTok is not believed by the U.S. government. On the Twitter side, it's a private company now, so I don't have a lot of insight into it. But I know from the reporting from industry observers, the strategic decision-making at Twitter has not been optimal, so to speak. So you have competitors stumbling, and looking back at Meta is still adding. They're still adding users. I mean, they added 30 million family app users last quarter, and that's on a base of over 3.7 billion. That's kind of amazing growth for a company this large.
And it's quite the turnaround. I mean, obviously, since Facebook changed its name to Meta and went all in on the metaverse, a lot has changed since then. As you mentioned, this year of efficiency, a lot more focus also on its AI push, its AI investments as well. Talk about the success of this turnaround and how much is really riding on this year of efficiency for Meta.
Well, I think quite a bit's riding on this year of efficiency. That's the quote from Mark Zuckerberg, the CEO. Yes, I mean, if you look at it in one way, AI is kind of the soup du jour right now. But really, Meta has put a lot of investment and money behind AI, and especially around this ad tracking issue. Looking to kind of get past that Apple ad tracking issue through AI, and trying to increase the ROI. On advertising, making that, again, regaining that kind of way to target ads through AI.
And we'll certainly be taking a look as Apple also wading into that VR headset space that Meta was also banking on as well. A big thank you there, Argus Research Senior Securities Analyst Joseph Bonner. Thank you so much. All right, coming up, the fall of commercial real estate. Wall Street forecasts something, quote, worse than the great financial crisis for the industry. We'll discuss next.
Credit default swaps, or CDS, back in the news, evoking memories of 2008 and the global financial crisis, as well as a Big Short movie, but we're talking about today. CDS contract amounts to an insurance contract on a bond or a loan to protect against the risk of default. That's the credit and the default part, but we want to talk about the swap part as well. And that refers to the exchange of payments or cash flows between the buyer and the seller. Now, when the contract is initiated, the buyer will make an upfront payment plus maybe quarterly or annual installments, and the seller is only responsible for payment in the event of default. That is a credit event. It could be a missed payment on the bond, or it could be the company filing for bankruptcy. Who uses CDS? Probably not you and me, but large institutional bond managers with millions of billions of dollars invested, they of course want to hedge their risk in the market. And for you and me, quite helpful to know what Wall Street is watching and what keeps them up at night.
The office sector of commercial real estate has come under scrutiny due to the recent banking turmoil and concurrent interest rate hikes. So Moody's analysts find that nearly a third of office buildings in its top 80 metros could be, quote, obsolete. So how vulnerable is the commercial real estate market? Morgan Stanley thinks prices could fall as much as 40%, but is commercial real estate's relationship with banks necessarily a doom scenario? Here to weigh in is Moody's Analytics Head of Commercial Real Estate Economic Analysis, joined by Commercial Observer's Finance and Co-Deputy Editor Kathy Cunningham. Welcome to you both. So first, I want to start with you, Kevin, because a lot of people, we first heard some of these warning signs from the Fed about the impact on commercial real estate when rates were being risen, but then also add to that the banking fallout from SVB. Give us the real context here as to comparisons that are now being made between that and the global financial crisis.
Sure. Thanks a lot, Rochelle, and thanks for having me on. So, yeah, I think we're in a very interesting time right now in the sense that there's a lot of hand-wringing going on, and there's a lot of legitimate expectations of a down cycle to come for commercial real estate, including from us. Where we might differ is on the magnitude, and there's a lot of reasons for that. If you go right to the banking sector question that you brought up, a lot of statistics have been flying around out there about somewhere between 65 to 80% of all CRE lending coming from regional banks. So if there's problems with regional banks, that's a major source of lending for the CRE industry. While it is a major source of lending, it's actually only about 13% of lending for CRE. There's a misreporting of that stat that's been kind of going around the echo chamber right now. And so that's one of the big differences, actually, if you step back for a second and look at GFC compared to now, the global financial crisis compared to now, the diversity of debt sources in the CRE market is much greater. There's a lot of non-bank lenders. CMBS continues to take up a big portion. Life insurance companies, Freddie now exists for the multifamily market. So that really helps bolster on the debt side. And there's a lot of fundamentals about the real estate sector that are very different now than they were 15 years ago.
And Kathy, you would think, based on some of the headlines that we're seeing, that this was a sudden issue that suddenly came up. But as you mentioned, this is something that was really happening years and months in the making.
Yes, for sure. I mean, I think our industry has really been in a prolonged period of market volatility as a result of the rising rate environments. We've really seen volatility, I think, in CRE lending for roughly 9 or 10 months now. Really, the rate environment's was such a shock to the system because it happened so quickly. And I think the collapse of SVB, what it really did was shine a light on some of the vulnerabilities within commercial real estate. And as Kevin said, yes, this seems like the end of the world. You see a lot of the headlines today, especially the comparisons to GFC, which I think is really the worst crisis that a lot of us can remember. But there are so many other different lender types that are still out there lending. The non-banks are playing a big role just now as the banks retrench and kind of sit on the sidelines. And I think, it's not all doom and gloom for sure. We're definitely going through what I think will be a very, very rough year for commercial real estate. But I think, not all is lost. And I think we definitely will recover from this, obviously. And it's a temporary time period of volatility.
So then, Kevin, as we look within the CRE borrowing space, then what are some of the trends that we should be aware of as you look out for the rest of the year?
Yeah, well, I think there's two sides of this coin. One is the CRE's exposure to banking as a lender, and then banking exposure to CRE as a potentially volatile asset class. And one of the stats that you just had up on there was the share of holdings of banks that are attributable to CRE. It takes some nuance actually to understand that statistic. And you really what accounts for CRE, like income producing properties, is actually a much smaller share of regional bank holdings. It's actually on average about 16.5% of their total assets. When you break it out, there are some that have actually some big concentrations. So they're definitely, if you feel like there's some problems in CRE, there are some banks to watch because of their exposures. But on average, it's only 16.5%. But as we go forward, you asked about things to watch. I think what we're really watching is the refinancing that are coming up right now. So, CRE loans are generally 5 to 10 year loans. So you're looking from the period of origination of 2013 to 2018. The good news is those were priced pretty conservatively relative to just before the GFC. So your spread, your cap rate spread, which indicates your enthusiasm about the future growth prospects for that property, and among other things. If that spread is really tight, that means you're being very aggressive in your pricing. But this last 10 years, we have not seen that. So there was pretty conservative pricing in that 2013 to 2018 era. And also LTVs on loans were 5 to 8% less. That's a really structurally fundamental difference between now and the GFC. You can take a lot more value decline before you experience a loss as a lender. So as these maturities come through, we're definitely going to see some pain. We can see default rates come up in the 5% range. Nothing like that. It was double that in the GFC. For sure, we're going to see some weaker assets that have issues in this next couple of years in that refi wave. But this idea of comparing it to what happened in the GFC, which was incredibly painful for CRE for some really fundamental reasons, is just not really a fair comparison.
And Kathy, to that point, you also note that, and you say it's actually a bigger comparison would be to the savings and loan crisis. Break that down for us.
So I really think the SNL also had the same context in terms of the rising rates. The GFC, I think, is so different at so many different levels because of the amount of financial engineering that happened during the GFC. Thank goodness today we don't see the same level of CDS, credit default swaps, collateralized debt obligations. All the things are very, very troubling for RMBS, CMBS, the residential commercial industries during the GFC. I do think that post GFC lenders have been far more disciplined, far more conservative in terms of the loans that they're making and their underwriting of those loans. And I also think borrowers have also been far more conservative or easy about the loans that they're taking and what they actually need and the amount of equity or skin in the game that goes into these deals. So I think the whole playing field when it comes to commercial lending is so different than 15 years ago, 16 years ago. And so we're in a better place starting off in this crisis than we were pre-GFC.
And Kevin, as we look within the specific types of commercial real estate, are there some that are perhaps holding up better than others?
Yeah, absolutely. It's a very diverse asset class. Before I go on to that, though, I would like to echo something that Kathy said there about the banks. There are some fundamental things in place now, some liquidity backstops, including one that was just started by the Fed called the BTFP, where banks can borrow for up to a year on the book value of their assets, which kind of separates them a little bit from the risk of value volatility. So it's a very important thing to note about what's happening in the banking sector. But to your point about heterogeneity in the commercial real estate asset class, that's one thing that people always have to remember. It is a very heterogeneous asset class, and even among the more troubled sectors like office. There are properties that are doing quite well. They have long leases, or they have, they kind of draw amenities. A lot of leases are still being signed. You don't see headlines for when big leases are signed, but you see big headlines for when they're not, or when tenants decide to move out. But when you get into the data, you see there's plenty of leases still being signed. Office is still a needed thing. Most serious people in the CRE market don't think that this is a functional obsolescence issue for the entire sector. They think it's a much more nuanced thing, and there's a repricing between 20 to 30% that needs to happen before lenders start feeling comfortable lending on office again. Multifamily has a little bit of issues. Affordability is becoming more and more of a problem across the United States, really. And the pricing on those assets actually has been very, very tight. So that spread I mentioned over the Treasury on your cap rate has been extremely tight for multifamily. So when these rates start to go back up like they have been, there's less breathing room, so you can see some real unexpected price corrections in the multifamily sector for such a strong asset class. The pricing has just been too tight for many of them. Industrial has been very strong. Retail has actually been quite strong, surprisingly. It's malls that really have experienced the most pain. They're going through a whole reinvention, akin to what some offices are going to have to go through. But the kind of normal neighborhood community shopping centers have been sleepily doing well. And hotels, they kind of bounce all around all over the place. Surprisingly, hotels are one of the only positive stories right now. Coming out of COVID, they got hit worse probably than any business sector at all, the hospitality. But they've made a big comeback. They've really ridden the wave of revenge travel that's still going on. The TSA numbers are still 110% over what they were in 2019. So that sector is actually doing well right now, but it's extremely pro-cyclical. So if the economy turns down, don't be surprised if hotel does as well.
It's certainly important to note all those nuances when people see some of these big headlines, to dig a little bit deeper there. A big thank you there to our panel, Moody's Analytics Head of Commercial Real Estate Economic Analysis, Kevin Fagan, and Commercial Observer Finance and Co-Deputy Editor, Kathy Cunningham. A big thank you to you both. All right, coming up, to the moon, or maybe not. Space startups struggle as free money becomes less available. What comes next for the final frontier? And will the industry overcome its troubles? We'll discuss next. Richard Branson's Virgin Orbit succumbing to the stiff competition in the race to get a piece of the space action. Here with more on what lies ahead in the space race is Eric Berger, senior space editor at Ars Technica and author of Liftoff, Elon Musk and the desperate early days that launched SpaceX. Good to have you on the show here, Eric. So looking at this time for space startups, where are we at the moment, especially as we now see the fall of Virgin Orbit?
Yeah, we're kind of at a perilous time for space startups because for a long time with low interest rates, they've been living with basically free money. And now we're seeing, capital availability dry up and it's being more expensive to borrow and raise funding. And a lot of these companies, Virgin Orbit included, we're still pretty far away from delivering profits or certainly positive cash flow. And so it becomes more difficult to convince investors to part with money when you have 675 employees and are launching 2 or 3 rockets a year. That's just not financially sustainable.
So then compare that to SpaceX then. Obviously SpaceX far and away now, especially with Virgin Orbit falling behind, the front runner here. What is SpaceX doing right?
Well, SpaceX has a rocket that can fly 60 or 100 times a year with the Falcon 9. And they've gone and made it reusable. And so they can just fly much more frequently and at a lower cost than all of their competitors in the United States and abroad. And a couple of years ago, they did something that really hurt companies like Virgin Orbit and to a lesser extent Rocket Lab and other small launch companies. They started these so-called transporter missions, which they fly about 3 times a year, where they pack a bunch of small satellites, so maybe several dozen small satellites into the Falcon 9 and launch them all at the same time. This is called a rideshare mission. And so whereas 2 or 3 of these satellites might have gone on Virgin Orbit's Launcher 1 rocket to a dedicated orbit, they ride for like a fifth of the price or something like that on the Falcon 9. And it just really undercuts the business model of a company like Virgin Orbit. There just was not the payloads there to sustain their business, even if they could have gotten their Launcher 1 vehicle flying more frequently.
And even when it comes to public-private partnerships, I mean, obviously we're seeing a lot of these billionaires appearing to control the space race. Does that change the dynamic of where the space race goes when you do have just a few parties able to make some of these moves?
It absolutely changes things. I mean, we have seen SpaceX in particular come in and really change the business model by which NASA operates. 15 years ago, they largely did space contracting by cost plus contracts. They would award a Northrop or a Boeing or a Lockheed a certain contract to develop a rocket or a spacecraft, and they say, we'll pay you all of your costs plus 10%. SpaceX has come in and said that, wanted these fixed price contracts and say, we'll get a fixed amount from you, like $2 billion to develop the spacecraft. And if we develop for less, we keep the profit. If we develop it for more, we eat that, but you get a firm fixed price. And NASA has gone to this model of purchasing services largely because of the success of SpaceX. And it's really the rest of the industry has had to adjust to that, and it's been a painful process.
So then as NASA prepares to return to the moon here, how much different is the space they're in? Not literally, but figuratively, the space that they're entering now, given how much has changed with the private and the startup market for space travel?
It's a big difference, and we can really see that transition happening. Last year NASA launched the Artemis 1 mission. There was this big space launch system rocket and the Orion spacecraft. Those programs are more than a decade, in some case 15 years old, and they were developed under the traditional cost plus modeling. But everything else is part of the Artemis program. The Starship lunar lander SpaceX is building, the space suits, the Gateway contract space station in lunar orbit, all of those elements are largely being developed under these fixed price contracts. And that's and through a services based model that I just talked about. And that's really probably how NASA is going to move going forward. And this is a huge difference than the Apollo program, which was largely done by a few contractors and entirely US based enterprise. The Artemis program is very much international. We saw that this week with the announcement of a Canadian astronaut flying on the Artemis 2 mission around the moon.
And we're expected to be days away from that SpaceX move with the Starship there. A lot of people wondering, at what point will SpaceX go public? What are your thoughts on that and what that could really do for the space investment industry?
Yeah, so SpaceX is now internally targeting, I think, no earlier than April 17th for that Starship launch from South Texas. The whole company, I just don't see going public for a long time, if ever. That's because the long-term vision of SpaceX, why it was founded, really was to settle Mars, as kind of crazy as that sounds. That is the underwriting vision of that company. And there is not much profit in that. So, being being, having to answer to shareholders for that probably is not something that Musk wants to do with SpaceX. However, I do think it's likely that we'll see Starlink. This is the satellite internet business spun off in the next few years, in which case people could own a piece of SpaceX through the Starlink program, which will be profitable.
We'll certainly be tracking that and all the launches that are upcoming. A big thank you there to Ars Technica's Eric Berger. Thank you for your time this morning. Well, St. Louis Fed President James Bullard is weighing in on the recent banking chaos and what it all means for the economy. This comes as the threat of a recession has reared its head again after some data this week showed signs of a weaker economy. Yahoo Finance's Jennifer Schonberger is here with the details. Jennifer, what are you tracking?
Good morning, Rochelle. St. Louis Fed President James Bullard says he doesn't think the reverberations from the recent bank failures are enough to tip the economy into recession. On a call with reporters just moments ago, Bullard estimated that 20% of bank deposits were leaving the system in search of higher yield, and that right now it's not clear to him that there will be much of a pullback on lending and thus a tightening in credit conditions. He said as long as banks have enough liquidity and capital, it seems they would make those loans if they were good ones to make. Now, on this point, there's been talk about lowering the interest rate on the Fed's reverse repo facility to encourage money market funds that have been parking cash at the Fed for higher yield to instead lend that back out to banks to get more money into the system. But Bullard says no plans to change that right now. Now, I also asked him about the latest JOLTS report that showed the biggest decline in jobs openings in nearly 2 years, though Bullard telling me he's not really drawing much conclusion from that data as it relates to a balancing out of supply and demand in the labor market. He says that right now, if you want a job and you lose one or you leave one, it's pretty easy to find another one in this environment. Rochelle?
And Jennifer, obviously a lot of people are going to be looking at every word that comes out anywhere from the Fed, especially since we are quite a ways away, it seems like, from their May meeting. Do you think this helps really perhaps at least get some of that messaging out there about the impact of the Fed really trying to balance this game of financial stability with trying to bring down inflation and stay the course?
Yeah, I think when it comes to Bullard, he seems to be a bit more focused on the inflation front. He puts the odds of about 85% that we are not going to see continued massive reverberations in terms of financial stability, and thus we will end up with sort of a slower growth scenario where the Fed is still going to need to focus on bringing inflation down. He is very aware of what happened in the 1970s. He does not want to repeat that, where essentially the Fed stopped raising rates, then had to come back in and really aggressively jack up rates. And that's really something that the Fed wants to avoid, because that's when you really get into scenarios for a severe recession.
Indeed. Jennifer Schonberger, thank you so much for that update. Well, a magical move now. Walt Disney World bringing back its annual pass, which were previously discontinued. These updated passes have some new benefits and are set to go on sale later this month. Yahoo Finance's Alexandra Canal has the details. Hey, Ali.
Hi, Rochelle, and that's right. New sales of Disney's Incredi Pass, Sorcerer Pass, Empire Pass will resume and can be purchased online beginning April 20th, although the company did warn that quantity will be limited. Disney fans, they've been asking for this. Currently, the only annual pass available for purchase is the Florida resident-only Pixie Dust Pass, which costs $399. That's quite a steal if you're a Florida resident, because these annual passes range in fees from $749 annually to nearly $1,400, and that's excluding tax. So it ain't cheap to go to Disney, but they do come with previously announced perks like free digital photo downloads, the ability to visit some of these parks after 2 p.m. without a reservation. And prior to those perks, we had a lot of customers complaining about long wait times at the parks, high costs. Even CEO Bob Iger, before he returned to the company in November, had reportedly expressed concerns over the high prices at these theme parks. We know how important these parks are to the company's bottom line, hence the need to keep these customers happy. Revenue for the parks division that came in nearly $29 billion in fiscal 2022, a 73% year-over-year increase. We also saw operating income jumped 65% year over year last year. And we saw parks continue to flourish in the first quarter of 2023 as well. So we'll see if Disney can keep up this momentum. They do have several projects in the works for this year, like the upcoming debut of the Journey of Water exhibit that's going to be at Epcot, inspired by Moana. They just debuted their Tron ride on Tuesday at Magic Kingdom. There's more character meet and greets, more experiences planned. So I think this is just another move that showcases how essential the parks are to Disney's strategy.
And just in time for the summer, people can hop on these, perfect timing indeed. And Ali, the parks announcement comes as Disney is also shaking up other areas of the business following its annual meeting of shareholders on Monday. So Ali, what can you tell us about that?
Yeah, well, late Wednesday, Disney announced that there are going to be key leadership changes within its streaming division, with Hulu president Joe Early becoming the new president of direct-to-consumer for Disney Entertainment effective immediately. He will take over the role from Michael Paul, who will be exiting the company after 6 years. Early, he's going to be overseeing all direct-to-consumer initiatives for Disney streaming services, which will include Disney Plus and Hulu. And when we heard from Bob Iger during that shareholder meeting on Monday, he said that streaming remained at the core of Disney's media strategy. He has emphasized that Disney Plus is on track to achieve profitability by the end of fiscal 2024. So this is going to be an important role. And it's just been an interesting journey to see how much has changed at Disney in the short time that Iger has stepped back into the CEO position. And I think you can expect even more changes like these leadership changes to come in the coming months and weeks.
We'll be keeping an eye on that. Ali Canal, thank you so much. Well, stay with us. There's more ahead this afternoon on our 3 to 5 p.m. show. We're continuing our coverage of the markets ahead of tomorrow's jobs report with Scott Ladner, Horizon Investments Chief Investment Officer. Plus, it'll be a travel trifecta this weekend with Easter, Passover and spring break all drawing big crowds at airports. Hopper's lead economist joins with what to expect for a busy few days of travel. And the Masters have officially teed off. On that note, we'll be hitting golf stocks to watch in the 4 p.m. hour today. You won't want to miss that. Right, well, let's do a final check of the markets before we go. A mixed picture here, really just the Dow under pressure here. We see the Dow there off about 52 points there. The S&P just down, in positive territory, ever so slightly though, by about almost 3 points. Tech-heavy Nasdaq there up about 39 points on the day. As we dig into what's weighing on the Dow though at the moment, we're seeing J&J and Visa as well as Salesforce weighing on the Dow there, down almost 1.6% for Salesforce there. That's taking a big jump. But some of the mega caps there, Apple and Microsoft, still buoying the Dow there, thankfully. And you also have the S&P there, still in good territory. Up ever so slightly, though, coming off it was on a downtrend earlier this morning after that weekly jobs data really weighed on markets there, wondering what the Fed was going to do, if it was doing too much, if it could potentially tip into recession, as opposed to perhaps being too mild with interest rate hikes and then having to raise them again. So we'll be taking a look at how that plays out for the rest of the afternoon. That'll do it for now, though. I'm Rochelle Akufo. I'll see you tomorrow at 11 a.m. Eastern.